I think we're in this sort of phony war right now where there's just a lot of uncertainty on the data.
I don't want to overreact to 1 month's number. If our base case is that economic activity is slowing.
You just really need to pay attention to valuations in a way that we really haven't had to.
The economy is still chugging along.
Why sacrifice the economy to the altar of a 2% inflation target if you don't need to?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Bloomberg Surveillance starts right now, live from New York City this morning. Good morning for our audience worldwide, with equity futures negative by a third of 1% on the S&P, closing out yesterday to start a new trading week at all-time highs on the S&P 500 and the Nasdaq 100, just as the two-day meeting kicks off for Chair Powell and the Federal Reserve. We begin this morning's program in Midtown West. Here's the address for you. 321 West, 44th Street, Manhattan. Bramo, tell us why we begin the program in Midtown West.
Well, it goes to sort of a bigger theme that we've been talking about for a long time, which is where are we in this commercial real estate reckoning? And basically, this is a New York City office building that also had the studios of P. Diddy on the second floor that is being sold for less than $50 million. Compared to north of $160 million back in 2018. That is a 67% discount. Again, it raises this question of, okay, is this beginning? Is this a middle? Is this idiosyncratic? Or are we just basically in the early stages of this reckoning?
So help me understand this transaction. This is less than what's left on the loan.
Correct.
Right, the loan is still $100 million.
Correct.
So this is like another example of the last 12 months of this slow-moving train. This sort of rolling stress from one sector to another, from one zip code to another. It started with the banks last spring, sort of got through that, stumbled on. Then we had a little bit of a hiccup in the Treasury market, September, October time. We moved on. You're going to see a few things like this. Can we keep moving on? I'm thinking of Mark Zandi of Moody's yesterday. You quoted him. That sticking plaster. We're just sort of holding on the system right now. Is that what this is?
Duct tape, this idea that we don't have any mobility whatsoever in a lot of the real estate markets. This is what people are hooking into. At the same time, I was speaking yesterday to an investor who said that her impression was we were in the sixth inning of this commercial real estate reckoning. And then she spoke to some analysts who said, no way, we're in the third or fourth inning. We are just beginning this. And that's sort of the uncertainty underpinning the question that you and I have been asking for a long time. How is it that we can get rates this high with no reckoning whatsoever in a credit market that grew up out of a period of very low rates?
So if you look at the household survey and the labour market, things are terrible. You look at the establishment survey, things are great. You look at the US equity market, things are fantastic. You look at commercial real estate, things are terrible. If you're the chairman of the Federal Reserve, the bifurcation that you're seeing in the economy right now, what on earth do you do to set policy, not just for the next couple of months, the next 12?
You don't do anything, which is what a lot of people are expecting today, is that basically they're going to hold tight. Stephen Major over at HSBC put out one of his bond letters, and I thought it was really compelling. He started talking about narrative fallacy, this cognitive bias in humans. We hook on to any data point and we create a narrative around it. And that's the reason why we've been creating a different narrative every single day, because we get different data points that can edify that. He's saying basically, if you look at the big picture, inflation has been trending lower. The economy is still strong, but softening around the edges. And the question is, and this is really the question for Jay Powell, when does the bias shift to fighting inflation to fighting growth concerns? And that is really the tipping point that a lot of people are looking for.
It's the conversation we had for most of last week until Friday morning at 8:30 Eastern Time when the jobs number dropped. Let's turn to a single name. That will be a big question for us this morning. I want to talk about Apple. It's down in the pre-market. We're negative by 0.7%. It was down yesterday by close to 2% at the close. Apple unveiling the longer-awaited AI features. I've got a list of them. Revamped Siri, partnership with OpenAI. We reported that here at Bloomberg. They're going to summarize text, create original images. It's called Apple Intelligence. Did you like that?
Well, it's sort of buy the rumor, sell the news. It was a little bit of that because people were saying, well, it didn't add that much that was new. Sort of a personal assistant touch, sort of a cross-referencing of some of the messages as well as some of the apps. I thought it was interesting. This is what Samsung posted on their Twitter site yesterday. They immediately came out snarky. Adding Apple doesn't make it new or groundbreaking. Welcome to AI, followed by an Apple emoji. So, a little bit of snark. We've been here for quite a while. That said, wait till it comes out. The feature where you could share payments was pretty cool, I got to say. Did you see that?
That's the bit that you liked? I missed that.
It was basically if you wanted to pay your friend $20, you just have to sort of put your phones near each other, and then there's just sort of like a light that goes through. Just
sort of shoot $20 over?
Look, I don't know how much this is going to move the needle.
That's not new technology, is it?
No, none of this is new. It's packaging. That's what Apple does best.
Got it.
That's essentially what's going on.
But are they going to do that this time around, like late but better? Because it doesn't feel that way this time around.
That's the correct point, right? They're late, but it feels like they're playing catch up. It's not as if they've been working on this the whole time to perfect it and make it beautiful and package it perfectly. There are also issues with Elon Musk and some concerns around security, and they're going to have to fight that on a sort of broader scale. But to me, this sort of shows how high the bar is right now to surpass expectations in AI adoption.
The stock a little softer again in the pre-market. The broader scores look like this. Welcome to the programme. On the S&P 500, we're negative by 0.3%, just a little bit softer. Yields are coming in, a bit defensive out there. We're down 3 basis points, 4.4374. More weakness on the euro. We're down 0.1%, 107.54. And French bond yields, we'll take a look at them a little bit later, keep climbing. Keep breaking out. Spreads a little bit wider again versus Germany on the morning over in Europe. Coming up on the programme this hour, we'll catch up with BlackRock's Russ Koesterich as the S&P 500 holds on to a fresh record high. Dan Ives of Wedbush on Apple's big AI reveal. And Blerina Uruci of T. Rowe Price looking ahead to Wednesday's doubleheader. We begin with our top story. The S&P 500 reaching fresh record highs as traders place their bets ahead of tomorrow's Fed decision. Russ Koesterich of BlackRock saying this: we think markets are vulnerable to modest pullbacks on both sticky inflation as well as the pre-election trade as we get into late summer and fall election season. That said, we think the market can end this year higher. Russ joins us now for more. So Russ, let's start with the equity market picture, sir. You've been trimming since spring. I know you're still constructive on the stock market. Can you just walk us through where you've been pulling back just a little bit?
Absolutely. Good morning, Jonathan. Look, we still think the market's going to end the year higher. We're still in a bull market. That said, we've taken a little bit off the table. We started doing that back in the spring. And I think it reflects a few things. One, the magnitude of the gains, the fact that you still have a lot of uncertainty around the Fed. And the sentiment is going to get a little bit more challenging as we get towards the end of summer and the early fall, and the market deals with the uncertainty of a very unusual election.
What about the election, Russ, are you concerned about? Because what we hear from a lot of people is that it's the bond market, not equities, and that's where the risk is. Is that how you and the team see things?
I think the biggest issue is really simply the uncertainty that hopefully will be resolved once the election is over. In terms of whether or not you're going to get aggressively long or short the market, it's generally been the wrong call. I think what you go back to are the fundamentals: strong growth, inflation that is moderating, albeit not in a straight line. But the reality is investors are likely to deal with some of the uncertainty in the run-up, and that often causes a little volatility in September and October.
Russ, it strikes me that we're talking about the equity market as a monolith and taking risk exposure as though all of it were exposed to macro risk or any risk whatsoever. How much you just basically hide out in certain cash-rich companies, the magnificent 2 or 3 or whatever is left, and basically stay away from small caps, stay away from those that are interest rate sensitive, stay away from those that are vulnerable to all these risks?
So, look, this is a great question. And I do think that the mega cap trend, again, not necessarily just 2 or 3 companies, but those companies that are exposed to these longer term secular trends like AI, like internet commerce, like cloud computing, they have further to go. So that is definitely part of it. And I also agree, you were talking before about real estate. One of the best ways to add value this year has been to avoid what I would call rate beta. In other words, those segments of the market, whether we're talking about low-income consumers and companies that are geared to their spending, commercial real estate, smaller regional banks, these are all parts of the market that generally going to be more sensitive to the fact that rates have actually grinded higher this year. And one of the things we've done is try to minimize exposure to those segments. Generally, that's worked, and I think you continue to do it given this higher for longer environment.
There's an angst that's developing because people need something to worry about, people being myself, as everyone basically says the same thing in terms of crowding into the names that have been just throwing off bucket loads of cash and staying away from some of the more rate-sensitive sectors. It's the reason why we've seen the Russell 2000 underperform. At what point do you worry about crowding and the sense that you can't avoid going into these stocks if you want to outperform, but that leaves the market that much more vulnerable to an idiosyncratic shock hinged to one of these companies?
I think this is a real risk, and it's very hard to argue that there's not been crowding, but it's been interesting. This is still a narrow market. It's still a market led by a handful of names, but you have seen some broadening out. Good example, utilities. Utilities is generally considered a low beta sector. It can be a very rate sensitive sector having a good year. Why is that? Well, of course, because for many investors, they're realizing that one of the constraints on the AI revolution is going to be electricity generation. And companies that are geared to that are geared to utilities, the grid, et cetera, many of them are having a great year. Now, this is something we didn't see 12 or 15 or 18 months ago, but I think it is an example of investors looking beyond 2, 3, 4, or 5 companies and thinking about what are the other beneficiaries of this AI revolution.
Russ, I've got to ask, though, if that means the correlation between utilities and the biggest market weight on the S&P 500 goes up, what am I actually owning in the portfolio?
Well, you're still going to have a very big exposure to that mega trend. And that's going to be something, along with economic growth and rate beta, that you're really just going to have to decide how much of that exposure do you want. That said, again, I think the reason that these trades have become crowded is that there are multi-year trends, and the companies that are geared to them, we know their names, are doing an amazing job of generating cash flow. And that's still a very desired commodity. And you think about what's working in this market, things like consistency, companies that can generate consistent revenue, consistent margins. And, again, if you can stay long those themes, I think you're going to do all right.
Saw this line from Mike Wilson of Morgan Stanley yesterday. He said, bottom line, the data remains mixed, leaving all the major macro outcomes on the table. Russ, it's never easy. I always sit here and say that. What you guys do is never easy. It's always easy looking back. But what about this moment is more difficult than maybe other moments in the past?
Well, look, I think I actually would agree with some of the premise of what Mike is saying, which is that it's complicated. Generally, the economy is strong, or it's certainly in decent shape. We had more evidence of that last Friday with the May non-farm payroll report. But there are segments of the market that are under pressure. We've spoken about the lower-end consumer. They are feeling the pain of higher rates, commercial real estate, the smaller banks. So I do think that generally, if you look at the economy, you've got strong growth. It's likely to moderate in the back half of the year. But you have to keep thinking about what are the segments of the market that are going to feel pressure, because we are in a higher for longer environment where the Fed clearly does not have the latitude or the desire to rush and cut rates.
Hey, Russ, great to get your thoughts. As always, buddy. Russ Koesterich there of BlackRock, breaking this equity market down. More broadly, the bond market as well, cross-asset. I'll share the fuller quote with you from Mike Wilson of Morgan Stanley. Bottom line, the data remains mixed, leaving all the macro major outcomes on the table for this year and supporting our recommendation for a barbell of quality growth and quality cyclicals with some defensive exposure. I think that's a highly sophisticated way of saying we don't know what the future holds. We don't know at all.
And he's not alone. I mean, a lot of people have been coming out with scenario analysis with ranges of outcomes depending on what the inputs are. A lot of people are looking for that from the Fed themselves. What's your scenario analysis? How are you dealing with some of the input data rather than just saying, we look at two things or we're data dependent? Choose your own adventure.
Yeah, this is frustrating for the Federal Reserve because we just sort of reduce all this down to their dot plot and the median dot for 24.
We work with what we're given.
Which is what we'll do tomorrow afternoon. Equity futures right now on the S&P negative by 0.25%. Let's get you an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. You guys mentioned this, that Elon Musk said he would ban Apple devices from his companies if OpenAI software is integrated into the iPhone maker's operating systems. He called it a, quote, unacceptable security violation. Apple announced yesterday that customers would have access to OpenAI's ChatGPT service through its Siri assistant, with a new feature set to roll out later this year. Musk co-founded OpenAI, but had a falling out with the company, and he's currently working on his own competitor to ChatGPT. Golden Goose and its shareholders are seeking to raise about 558 million euros in the luxury sneaker brand's IPO. That gives them an implied market value of as much as 1.9 billion euros. Bloomberg had reported that Golden Goose was seeking a valuation at about 3 billion euros, a valuation which at the time the CEO told Manis and me on Bloomberg Brief that he was happy with. The main shipping channel into Baltimore's port has been fully reopened following the March collapse of the Francis Scott Key Bridge. It follows a massive cleaning operation with workers removing an estimated 50,000 tons of steel and concrete from the water. The wreckage left the port of Baltimore effectively closed for several weeks during that cleanup operation. Officials say they hope to rebuild the bridge by 2028. And that is your Bloomberg Brief. John.
Danny, thank you. What a fantastic effort. More from Danny in about 30 minutes' time. Up next on the program, Apple's AI let down.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights.
That conversation just around the corner, live from New York City this morning. Good morning.
Wednesday, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Happy to confirm TK back around the table tomorrow afternoon for the Fed decision, a Bloomberg Surveillance special kicking off at about 1:30 Eastern time. Don't miss it. As the two-day meeting kicks off down in Washington, D.C., equity futures pull back by 0.25% on the S&P 500. Yields lower by 3 basis points on a 10-year, 4.4315, and in foreign exchange, the euro, 107.45. Under surveillance this morning, Apple's AI let down.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
So here's the latest. Shares of Apple sliding after the company's long-awaited announcement on artificial intelligence. CEO Tim Cook saying ChatGPT will be coming to its operating system for iPhones and computers later this year. Elon Musk saying he will ban Apple devices from his companies if OpenAI is integrated, calling it a security risk. Dan Ives of Wedbush joins us now for more. So, Dan, let's separate the two stories. The complaint coming from Elon Musk and what was unveiled yesterday, and you were in Cupertino, California. So, Dan, tell me how impressed you were by yesterday's release.
I thought it was a historical moment for Apple because this is really now, as much as we talk about the generative AI from an enterprise perspective, the consumer AI story is going to go through Apple. This was significant. I believe this will be a catalyst to an AI-driven supercycle over the next 2 years.
Dan, we started the program by talking about Apple always being late but better. Can you tell me if this is late and better? It feels late. I just need to understand if it's better.
Yeah, I think Lisa was exactly right. It's late, but you have 2.2 billion iOS devices. So they could be late, but they have an install base that's unrivaled. And that's really what they're going after right now. It's going to be on the services side, the monetization. I think eventually will be a subscription service. And then this is something, if you don't have an iPhone 15 or later, you're not going to be able to access Apple Intelligence. And I think that is the key. The headline here is the long-awaited upgrade cycle that we've talked about a lot on the show is now in front of us.
So let's dig into that a little bit, Dan. If we don't see a material uptick in sales, say in September, November, December, and October, are you going to basically retrench some of your bullishness, or do you think it could come as late as next year and it still would be valid?
Yeah, if that doesn't happen, I'll come into the studio wearing a black sports jacket because I believe this is the start of a renaissance of growth. And I think what's important now is that Apple, really unveiling their AI strategy. Of course, Altman there, the OpenAI being significant. I mean, this is ultimately most consumers, 25% in the world, they will access AI through an Apple device.
Well, if we end up with sales as soon as next week, you'll be wearing the drapes. Dan, I am curious about the idea of a subscription service. What are people going to be subscribing to, given the fact that right now you've got Apple Music, you have a number of other services? Are they going to subscribe to Apple Intelligence?
I think at first it's free, and that's the key for any Apple user. But this is essentially an AI brain in the iPhone. And where eventually this is going to go, developers that were all there yesterday that I saw, they're going to be building hundreds of apps based on this technology stack within the Apple ecosystem. And that's where more and more consumers are going to interact with it. This is just the start of now this AI party coming to Cupertino. But as much as it's late to the party, it's still 9 p.m. in this party that I believe goes to 4 or 5 a.m.
So, Dan, can you tell us why Elon Musk doesn't want to attend?
Because Musk, it's sour grapes. Because ultimately, this is what he wanted to do from a Tesla perspective. Obviously, there's a beef with OpenAI going back, years. But this is essentially Apple in their castle saying, it's our data, it's our customers, you're not going to have access. But I believe Musk, this could be just some stress going to shareholder meeting this week. He's not going to ban iPhones, in my opinion.
In super, super simple terms, can you explain what his complaint actually is? What's he concerned about?
He's basically concerned about Apple and OpenAI having access to the data and no one else has access to it. And that what he speaks to would be a broader concern among other tech players, because Apple has a castle that no one else has. They have the devices. It's 1.5 billion iPhones worldwide. And they're saying it's mi casa, not su casa.
So, Dan, you mentioned Musk and Tesla and some of the issues he's having. That stock, that name falls under your coverage. You're clearly very, very constructive on Apple. Where are you now on Tesla?
Look, I think they've gone through a Category 5 storm, but they're starting to turn the corner. And in terms of what we see later this week, I think that comp package does pass. That does remove an overhang. And then it's all about stabilization in China, FSD and autonomous going forward. But I think right now the risk reward is there positive. That's why the stock, I believe, is hanging in, even though they're going through some tough times from a demand perspective. Better days ahead, despite what's definitely a white knuckle period for Tesla shareholders.
That said, Dan, we talk about the AI supercycle, and that's the reason why Apple is sitting in its castle and creating a party that's going to go to 4 or 5 a.m. But there's a question for Tesla where you have Elon Musk. You said sour grapes about not having this first. This is what he wanted. He wanted the castle, and reportedly diverting chips from NVIDIA, from Tesla, to some of his other efforts because he has no place to deploy them. Does that concern you at all in terms of Tesla's valuation as a technology company and not as just a car company?
Yeah, look, the AI initiatives have to be under Tesla. And I think when Musk made that threat, and this will come out at the shareholder meeting as well this week, 25% ownership, otherwise he takes AI out of Tesla. It does raise some concerns, but I believe at the end of the day, it's all going to be under the hood of the Tesla ecosystem. And look, Musk right now, it's a balance. But it's a pivotal time for Musk to prove that AI will be under Tesla. He recommits to being CEO, I believe, the next 3 to 5 years. And I think then we have better days ahead. But right now, it's definitely been another turbulent period, and he doesn't help that.
Dan, on a bigger level, this is the first day of a 2-day Fed meeting, and a lot of people are wondering, how long can this continue, where the AI early starters just basically accumulate all the cash and are the winners and accumulate all of the investments that we have from a lot of different investment managers, and they leave most people behind? How long can that divergence continue before something's got to give?
Look, I've been in the Valley now for 2 weeks. Seen 20 tech companies, all front and center in terms of the AI revolution. This is a 1995 moment, not a 1999 moment. And what I mean is the stronger and get stronger. And I don't see any slowdown, what we're seeing here, what we're seeing in terms of supply chain in Asia. And that's why I believe this is a tech bull market that continues to go forward for the next 18 months. But they'll be in the right lane, 45 miles an hour in the minivan, worrying about valuation. I just think right now this tech party is going to be left lane, 100 miles an hour. I don't see it slowing down.
So, Dan, I've got literally 5 seconds. You're going to have to do this in a single word. I'm prehistoric, pre-iPhone 15. What's the one reason I'm upgrading? Just one word.
It's Apple Intelligence. Because I'm going to have it, you don't, and you're going to want it.
Trying to work out what the function is. Dan Ives of Wedbush. Dan, thank you, sir. More still to come on that. We'll catch up with Tom Forte a little bit later.
Join the party. Just get in there.
Just get in there.
It's 9
It's going to be like
PM.
envy. It's
exactly.
Is that what it is?
It's
okay.
joy.
Coming into Tuesday, and all-time highs on the S&P 500 and the Nasdaq. Equity futures look a little something like this morning. We are negative by 0.25% on the S&P. On the Nasdaq, we're down 0.25%. Also on the Russell, negative by 0.75%. I mentioned Mike Wilson of Morgan Stanley a little bit earlier this morning. This is what he had to say, Lisa, on the small caps. We view higher rates as a clear headwind to small caps, but we're skeptical that lower rates offer a comparable benefit. A key reason we remain overweight large caps.
And frankly, this has been borne out by the response in markets to any kind of move in yields. Basically, when yields go up, the Russell gets punished. When yields go down, the Russell hangs in and doesn't really gain that much. And that's basically what he's saying. At the same time, if you have the idea of lower yields and slower growth, those are going to be the companies that hurt the most.
Those stocks negative this morning. Let's turn the page to the bond market. 2-year, 10-year, 30-year looks a little something like this. We're down 4 basis points on a 2-year to 4.84 on a 10-year. Coming into today, yields were higher for 3 consecutive days. Now they're lower by 4 basis points at 4.4296. If you look at where we've been, Lisa, look at where the 10-year yield opened up 2 Mondays ago. We're below those levels right now, even with that big adjustment on Friday post-payrolls.
This sort of speaks to the point that Stephen Major was getting at. And the market is perhaps realizing the same thing. There is a downward trend, albeit fairly slow, when it comes to inflation going lower, disinflation. The idea that pace of price gains are moderating. Question is how quickly. Question is what the response is going to be. This is a reason why Major was talking about that pivot point where people stop talking about inflation and start talking about growth. We've been talking about that pivot point for months now, and we haven't gotten it. I think that's what people are trying to sniff out, the reason why there's so much volatility in bond yields.
Yeah, we've said this a few times now. It felt like that last week, for the whole of last week, until Friday. Remember, the ISM services came in better than expected. Everyone was focused on the subcomponents, on the employment component of ISM services. And you and I both said that feels like a stretch, but that's where the market was. Then it flipped back, just like that, at 8:31 on Friday.
How do you get an advantage in a market like this?
I think it's incredibly tough.
Which is the reason why you have people doing scenario analysis, do this, do that, whatever. But at the end of the day, buy NVIDIA. I mean, that's essentially all of the notes that I read. That is a subtext. And that's the reason why you saw the 26th record close for the S&P 500.
The 26th,
yesterday.
you're still counting?
Yeah, 14th for the Nasdaq yesterday.
With the team here at Bloomberg.
Yeah.
Good stuff. All right. We're going to keep counting as well. Just need to be a little bit higher again today. Let's turn the page. If it could get any harder, you just have to introduce sort of like European politics, and that's what we've got. The euro negative by 0.2%. Things haven't settled down in the French bond market. Yields were up by double-digit basis points yesterday. We're up by another 6 today. Spreads, France versus Germany, least at the widest of the year.
Yeah, and they widened the most yesterday in more than a year, just surging as people perceive the risk that, frankly, Emmanuel Macron introduced himself by calling a snap election. A lot of people saying, though, it's not as big of a risk as it seems. He has this mantra that he tells his staff, Emmanuel Macron, that, you know, you have to take risks, you need to be bold. But there was going to be a vote of no confidence that some of the far-right party were going to hold against him that would have probably neutered his ability to really do much for the remainder of this year. So this is trying to get ahead of that as well. There's been already a lot of turmoil, and this is sort of just crystallized by holding the snap election.
Don't you just love European politics?
I do, actually.
I know the runway in America is much, much longer, and it can be a bit crazy sometimes, but European politics, this came out of the UK this morning in The Sun, the newspaper, that candidates have been complaining that doorbell cameras have stopped people from answering the door to people trying to canvass them for their political party. So if you see a leaflet, you just don't open it. And what they're reporting is that one canvasser started carrying a parcel, a package, so that people thought they had a delivery, so that then they'd open the door and talk to them.
Oh my God, I feel bad for the canvassers, but
it's like
also
campaigning in 2024.
Hello, do people want those calls? No. Nobody wants to answer that door. If anyone answers that door, they will only stand there and listen to them out of social guilt. Period.
Some people do, though. You know, there's 2 types of people. You know, the people that love that stuff.
Well, yeah.
Like open the door, like a good debate, an argument. Labour's here.
Full disclosure.
Sort of like run out.
One of my family members, when they get a spam call, they try to really engage.
Oh, they engage?
Yeah, they're really interested, like over-interested, and see how long it can last. My response is, you guys have way too much time.
Well, like a scam where they're trying to get money out of them. They play along.
Oh, yeah. They ask lots of questions. They ask about the person.
Is that a family trait?
Let's move on.
Are you revealing something that you do as well?
No, I don't have time.
OK. I've got no time for that either. Got time for that? All right. Under surveillance this morning, Apple looking to catch up in AI. The iPhone maker announcing new integration with ChatGPT. The features called Apple Intelligence will roll out later this year, but more advanced tools won't come until next year. The stock was down by close to 2% yesterday, down another 0.25% this morning. Going through those features, we did this about 30 minutes ago. I'm just trying to work out what's going to get me to upgrade here. A revamped Siri that I don't use anyway, a partnership with OpenAI, maybe. They're going to summarize text, that might be useful. Create original images, zero interest in that whatsoever. Yeah, I don't care for that stuff.
You never did like Bitmoji and all that stuff?
No, I haven't used any AI tools to do anything like that at all in the last few months.
You probably have and you don't know it.
I'm just not the audience for this.
Okay, you're not the audience for this. I will say, Tim Cook used a word that I thought was really interesting and was actually a very Apple word, which is delightful. Right? They're looking for people to play on their phones and use them as a tool that is addictive in that kind of delightful way beyond just sort of a personal assistant. So they have the personal assistant kind of aspects where things talk to each other, filling in your sentences. But some of the features like being able to exchange money in this cool way that it sort of zips up. It looks like a sort of old fax machine or something that's going through your phone and then going into their phone, or some of the pictures. I could see how particularly a certain cohort, that would be very exciting. And you're in a sort of social setting and there's a sort of peer pressure. It's like, why can't I get that?
Gotcha. But you said it earlier, it's packaging, not technological advancement,
100%.
right? Like, we already have that.
But isn't that what Apple does best? It is all packaging. Even the packages of their iPhones are kind of cool. Like, other things don't have them. They're brilliant at packaging. Can that get them over the hump? Well, Dan Ives thinks so. But, you know...
Sounds like you do too.
I actually know that it is bad to just outright be skeptical of some of these advancements because people go and they line up to spend thousands of dollars.
Oh, totally.
So I do understand that. On the flip side, I don't know if this is really what people were hoping for on a broader level when you talk about artificial intelligence. Is it a personalized Bitmoji? I don't know about that. I think that people were hoping for a little bit of a different kind of productivity boost than just more time on your phone.
The stock is a little bit softer this morning. More time on your phone, but maybe less time on Google and Google search, which is a conversation we'll have a little bit later this morning. Let's turn to this story. Secretary of State Antony Blinken looking to gain support for President Biden's peace plan between Israel and Hamas. Blinken saying Israel's Prime Minister Netanyahu is committed to the proposal after a meeting today. This marks Blinken's 8th trip to the region since the war broke out back in October. We know what Israel wants, release the hostages. We know what Hamas wants, which is some kind of post-war commitment from Israel that Israel right now is not willing to give.
The more that I learn about the situation, the more confused I get. The UN just passed a ceasefire resolution with 14 votes and 0 against, 1 abstention. U.S. voting for it, saying that Israel was on the same side, and now the question is over in Hamas. Very unclear what's going on. The details unclear. Benjamin Netanyahu has rebutted some of the assertions that the U.S. has said. Honestly, it is very difficult to get a handle on. Everyone's just hoping to get a resolution sooner.
Tough meeting for Blinken, that's for sure. The eighth visit, amazing. Let's turn to this final story. Mexico's President-elect Claudia Sheinbaum vowing to move ahead with reforms of the judiciary system. The announcement raising fears it will erode checks on the power of the ruling party. The peso making the strongest move in EM currencies as the US dollar heads for a 4th day of gains. Steve Englander of Standard Chartered joins us now for more. Steve, these are the worries that people have when it comes to EM. You worry about things like judicial reform. Steve, how important is politics going to be to emerging markets and more broadly to foreign exchange this year?
Well, it looks like it's getting increasingly important, in part because the market underestimated just how important and how big the shocks might be. MEX is getting pounded in part because it was everybody's favorite trade a month ago. So, if there were any long positions in the market, it was long MEX and short some low yielder. And those positions have been unwound. And if they haven't, they're getting unwound.
But Steve, how much do some of these events, whether it's the election in Mexico, whether it's the election in India, whether it's the European Parliament, EU Parliament elections, how much does this just sort of underscores the preeminence of the dollar as a haven, despite some of the political dysfunction here in the United States?
Well, we have an election of our own coming up, but I'd say that the shocks that we've seen abroad kind of, make the U.S. election look, the differences look kind of relatively minor. I think that it will come into play, I think, later on as perhaps the, policy agenda of Trump and Biden become more clear and the divergences become clear, the implication of the elections become more clear. I know everyone sees that there's a colossal difference between them, but in terms of practical politics and practical policy, it's not exactly clear what one would do that the other wouldn't. I think that will become more clear as the election approaches. But we've had these massive shocks. With the euro, I think everyone kind of went in kind of complacent, like European elections. That's like a headline that puts you to sleep. And all of a sudden you find the sort of the right wing sort of really picking up, and it has implications for what the EU can do as a bloc. It has implications for how the ECB has to respond. It has implications just because we don't understand how this is going to play out.
Unprepared. That is the word that I want to key in on, Steve. You're saying this just shows how unprepared markets were from some of these outcomes being more dramatic than expected, even though, quite frankly, a lot of these outcomes have been expected. Stephen, how unprepared is this market going forward to other potential political catalysts that could come down the pike at a time where we're coming off a pretty stagnant time, at least for some of the major currency pairs, and it has led to leverage and carry trades and all sorts of other things that could be unwound in the face of some sort of catalyst?
Look, I got to put on my nerdy hat. I think what happens, you have inflation that goes up a tenth, it goes down a tenth. You move the currency up or down a little bit. You have a political shock. It's like you go from one state of the world to the other. That's a much bigger shock. I mean, it doesn't happen that often, but when it happens, you have to sit back and say, wait a second, is this really kind of the marginal moves that we're seeing when CPI comes in 0.2 instead of 0.3, or is this like a big deal? And I think the market's, trying to digest whether this is a big deal.
Steve, that's the game we'll play tomorrow, the dot plot. If it comes down to 2 versus 1, how big a difference is there if the median dot shows 1 cut versus 2 for 2024?
I think it would be massive because, 1 cut runs down to 0. And, and I think that would lead the market to think that there's a real chance that the cutting agenda and all the talk about we're making progress, it just takes time, is off the table. And we think that maybe there's a 1 in 3 chance that they do go down to 1. It's not going to be like everybody in favor of 2 and nobody in favor of 1. It's going to be very close. If the 1 does win, I think we'll see probably the dollar, break the year's highs. We'll probably see yields go up significantly, and markets looking at the these sort of reluctant cuts that so far are priced still into the end of the year. June and July are kind of out of the picture, but and kind of say, are these going to what are the chances that these actually manifest themselves? We think the Fed will avoid that because there's no reason for them to throw that kind of message into the market right now. I don't think that they want to send that signal, but if they do, as our Fed piece, it's not going to be unintentional. It's not going to be an accident that they say, oh, we're at 1. The things happen.
Yeah, but Steve, can I jump in? How does that actually work on the committee? How do you get everyone to sort of coalesce around the idea, I don't think we should go with 1? Do they look around the table and go, hey, Neil, can you bump that up a little bit? Can you go with 2 for this year? Just want to make sure the median comes in right. Steve, how do you do that?
Look, from what Fed Chair Powell has said, they don't do that. But, I think they're all aware kind of what the implications might be. And Powell has reiterated several times that they can change it up to, the morning, Wednesday morning, so that there's I think some of them kind of go out and say, look, is this the optics that we want? And you can find 1 or 2 to change it. It doesn't happen as a formal request, but it kind of happens organically.
Got it. Steve, thank you, sir. Steve Englander there of Standard Chartered. And whether we should be arguing about 5 basis points here and there, but ultimately the difference between 2 and 1 on the median dot tomorrow is, quote, massive.
Yeah, he says it's a major hawkish shock. He has it at something like a 30 to 40% probability at a time when potentially this could send a signal that they don't really want to send, according to Stephen Englander. So then do they take a straw poll and basically engage with peer pressure? Come on, just push it up just a
little bit.
A dot. Come on.
I keep using Neil's name, which is unfair.
It's okay.
I'm not saying he's susceptible to It's peer pressure.
He's actually probably the least susceptible.
Neil would be like,
pressure.
Excuse me.
Yeah.
Sticking with one.
He'd be like, you know what, just for that, I'm taking that
Assuming
off.
his dot would be there. One, who knows where his dot might be.
You can come on and tell us. Thanks, Neil.
We'll cover this tomorrow. That's going to be the show, basically, at about 2 p.m. when the decision drops. Sort of going through the dot plot. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bill Gross says that Europe is the place to look for opportunities. Gross said that to Bloomberg the day after two of Europe's most influential leaders, France's Emmanuel Macron and Germany's Olaf Scholz, suffered surprise defeats in the Sunday European parliamentary elections at the hands of the far right.
I think in terms of an attraction, German tenure Bunds and French oats, the tenure there, their spreads have narrowed significantly in the past month or two relative to treasuries, and today as well by 8 or 10 basis points. So there's coming a point where European bonds are more attractive than treasury bonds, in my opinion.
Gross went on to say that the recent market reactions to other elections from Mexico, India, and South Africa also offer a guide for how U.S. campaigns might impact assets in November. A New York City office building owned by a related affiliate is set to be sold at a steep discount. Empire Capital and Namdar agreed to purchase the property at 321 West 44th Street for less than $50 million, according to people familiar. That's a roughly 67% discount from its original 2018 price tag. Singapore Airlines has offered payment of $25,000 to passengers who sustained serious injuries during a flight that hit extreme turbulence last month. The payment would be address their immediate needs, the carrier said in a Facebook post on Tuesday. Singapore Air is also offering $10,000 to passengers who sustained minor injuries. One person died and several dozen of the 229 passengers and crew on board were severely hurt on the flight which departed London bound for Singapore. It was first forced to make an emergency landing in Bangkok. And that is your Bloomberg Brief. John.
Shocking. Absolutely shocking. Danny, thanks for that. More from Danny in about 30 minutes' time. Up next on the programme, a losing game.
Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed.
I think we've all missed that conversation. Up next. Stocks negative this morning, pulling back from all-time highs on the S&P. Just a little bit softer, no real drama. Down 0.25%. Bond markets rallying, going against the grain of the previous 3 days. Yield to lower by 4 basis points. The 10-year 442.76. Under surveillance this morning, a losing game.
Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed. The Fed's not going to move Wednesday, that's no secret. Yeah, it might tweak the dots a little bit, big deal. But the bigger story is CPI. Does it really change the chance in a meaningful way the Fed really could cut this year?
Here's the latest. US Treasuries rebounding ahead of tomorrow's doubleheader with US CPI and the Fed on deck. Blerina Uruci of T. Rowe Price writing this. Given the resilience of the labour market, I think the risks are skewed in a hawkish direction. The dot plot could have only one cut this year. Blerina joins us now for more. Blerina, Steve Englander just moments ago said the difference between showing 2 cuts this year and 1 is massive. Do you agree with that?
I think the consensus view is that we're probably going to end up with 2 cuts in the dot plot, but that risks are skewed toward that 1 cut, and there's going to be the distribution will be interesting because it will show almost an evenly split FOMC between 1 and 2 cuts this year. So with that information in hand, I think the market has been able to absorb this. And I think at the end of the day, what's happening here is that the median in the FOMC, which I think, and most of the members, which I think includes Powell too, want to keep optionality about being able to cut interest rates as early as September. That's what that 2 dots is all about. And I think with that in mind, they'll let the data then increase or lower the probability of a cut in September. I think from my perspective, the direction of travel is that we keep pushing back that first cut because the signal from the labor market is going to be that it's resilient, it's loosening, labor market conditions are not as tight as they used to be, but the labor market is resilient. And then it's going to come down to how fast can you bring inflation to 2% for the Fed in this environment of strong demand and resilient labor markets. And we've figured out this year that that progress is likely to be slow.
Just to pick up on the labour market point, how conclusive is the view on the labour market data, particularly the data we just got on Friday?
I think what you're alluding to is maybe this mixed messages. We're looking at jolts, and that's where all the slack in the labor market has been created in recent quarters. The vacancy rate is down, quits are down, the churn in the labor market has slowed down significantly. You look at something like claims, the unemployment numbers are not increasing a lot. The unemployment rate has picked up slightly, but when you look at payroll growth, the rate of job creation in the economy remains pretty resilient. So a bit of mixed messages. What I'm reading from this mix of labor market data is that, yes, there is some slack being created because demand for workers is not as strong as it was in maybe 2 years ago. We also have more labor supply to fill those vacancies, partly because of the strong migration flows that we've seen in the last 2 years. But demand for workers has not collapsed. Also, we're not seeing firms lay off their workers. And this idea of labor market hoarding, because it was so hard to fill those vacancies post-pandemic, many firms got burned, so they'll hold on to workers for longer than they would in other business cycles.
Blerina, it strikes me that people aren't sure of what's important and what's not to focus on. I mean, we heard Mike Schumacher saying that if the Fed kicks the dots down a couple, one by one dot, it's not a big deal. Then we heard Steve Englander say it's massive. It would be a huge hawkish shift. You have some people saying that the economic data has shown employment weakening. Other people saying, actually, there's a revival under the hood if you point to this and that and the other. What would you have to see to really materially change your view? Is there a data point or a data set that you are watching carefully to understand cracks that could really alter the landscape of just dramatic uncertainty?
What we've looked at in past business cycles is the labor market data. And by that, I mean, let's look at the weekly claims. Are we seeing signs here that workers are losing their jobs in large numbers? Let's look at the challenger job cuts. Are we seeing signs there of widespread layoffs? Back in late 2022, the tech sector was laying off workers and maybe a few in the finance sectors, but it was not broadly based. So I think to start this recessionary cycle that people worry about, you need more broadly based layoffs. You need cracks in the labor market, and we have good forward-looking indicators and weekly data to monitor here. We're looking at company reports. We're looking at consumer spending. The data is giving, broadly speaking, I think, a message that conditions, fundamentals are still strong.
Are you concerned at all about a financial accident like Mark Zandi was talking about, given that the system is an engine that's just rattling with duct tape, kind of holding it together and patched up with Fed policy? That was his description.
We had our financial market shock with SVB. We did also a lot of balance sheet cleanup post-COVID. When you look at the assets overall of the banking system, it's strong. There's always a question about how opaque is private credit, private equity. It doesn't seem from looking at the data at a macro level that it's large enough to pose a systemic risk so far. And the Federal Reserve Board talked extensively about this in the Financial Stability Report that they publish every quarter. So there's always reasons for concern, and I think vigilance is important. I'm not losing sleep over that right now.
Blerina, appreciate your time as always. Blerina Uruci there of T. Rowe Price going into the Fed decision tomorrow. Mentioned Steve's work a few times, caught up with Steve Englander of Standard Chartered just moments ago. Many in the market would see a single cut as backing away from the policy rates of peaked view, opening the door to serious discussion of the possibility of further policy rate hikes. Would that really bring that back on the table tomorrow afternoon?
It takes so little to get people talking about anything, because that's how sort of uncertain everybody has become. So I could see how that could happen.
In the second hour on Bloomberg Surveillance, we'll catch up with Omar Aguilar of Schwab Asset Management, Aaron David Miller of the Carnegie Endowment for International Peace, Tom Forte of Maxim Group. on Apple's new AI. And Iain Stealey of JP Morgan Asset Management.
It's not obvious to us that there's urgency for the Fed to ease.
I think they'll continue to stay their data dependent and that the data is murky.
Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed.
Obviously, the market's going to take any cut as a start of an easing cycle.
I don't think the market really cares whether we're going to get 1, 2, or 3 this year, as long as the next move is down.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, where we will play a losing game. Okay? You ready? I mean, that's what we're going to do.
Sounds like a lot of fun.
Yes. So Ben Lader of eToro says this: I don't think the market cares if it's 1, 2, or 3 cuts this year. Okay? Steve Englander of Standard Chartered comes on 10 minutes ago, and we ask him what's the difference between signaling 1 or 2, and he says massive.
Yeah.
So basically, this is the next 24 hours. Some people say it won't matter. Other people say it's a big deal.
You know, I'm glad you began with this because it goes to the heart of how people can understand what's going to happen in terms of the data, but really not understand the market reaction. We've gotten a couple of different catalysts, whether it was a French election, or whether it was the EU parliamentary elections, or whether it was some of these data points that were largely expected, where nobody could really understand what exactly the market response would be. You have JP Morgan strategists coming out overnight and saying that either way, if there is an upside or downside surprise in CPI, it could be a pretty massive move in equities, and it could be undone by the Fed just hours later.
The word I keep hearing is optionality, not just at the Federal Reserve, but also at the ECB. They want the optionality. They want the flexibility in the incoming meetings to do whatever they need to do. I see that in the work from Goldman, too. We think the leadership would prefer a 2-cut baseline to retain flexibility. I'm not sure how you get the FOMC to sit around the table and put in their individual projections to try and come up with this beautiful, perfect 2 median dot showing 2 cuts for 2024. Maybe that's how things turn out, but can you construct that sitting around the table? I'm not so sure.
It sounds much more top-down than the actual cat herding that it actually is, at least from descriptions of people who have been on the committee. Question is, going forward, how much of that 2-cut baseline to preserve maximum optionality is in part representative of the schedule, right? I mean, if they put 2 cuts and if the data weakens, softens considerably and they cut in July or September, they are less exposed to political accusations if they already have 2 cuts penciled into their baseline in terms of their dots. So in terms of optionality, that could be part of what's behind that.
2 makes more sense than 1. You have the space to reduce it from 2 to 1 later this year if you need to. September's still a curious one for me. I know a lot of people might point to the fact that we did, I think, QE3 back in September, was it 2012, September 2012? I know lots of people point to that date as just an example that you can do big things going into an election in November. They know the spotlight's on them big time in a way that maybe it hasn't been before.
The bar has gotten higher in terms of their justification for cutting, especially at a time where this is a peripheral data point. But this morning we got small business optimism, and it came in stronger than expected. Again, this is not showing signs of a dramatic weakening in an economy that is shown to be a bright spot in the global economy. So you raise this question, what are we missing? Can you discount everything and just cherry pick the data that shows weakness for long enough to get you justified rate cuts? Or are they looking for something else?
Yes. I think yes, and you knew that was the answer to that too.
I mean, it's a losing game.
Yes, that too. Equity futures on the S&P. Your scores look like this, pulling back by 1/3% on the S&P. Record high close yesterday on the S&P 500 and on the Nasdaq too. This from the team over at Bank of America. No landing is back in debate. That's not bearish. Lisa, I'm sure you saw the same thing.
Yeah, I mean, this idea that no landing is actually a positive going forward at a time where we can just sort of grind out some kind of growth. Again, I actually do think that one of the bigger fears that's kind of percolating to the surface is the longer this goes on, how much crowding in a number of the winners really just continues, considering that there isn't anything to shake that.
Yeah, the conclusion's the same for all of these conversations.
All of them.
You said it, it's NVIDIA, like consistently.
I mean, what's there to not like? And frankly, the other consistent theme that I'm seeing in all of the different notes is we could see a pullback in the next couple of months. There could be some sort of volatility, but buy the dip. We've heard this repeatedly, and so there has been no dip.
It's the ultimate barbell. It's like T-bills on one side and NVIDIA on the other. Coming up this hour, Omar Aguilar of Schwab ahead of tomorrow's CPI and Fed doubleheader. Tom Forte of Maxim on why Apple's new iPhone could create problems for its customers. And Iain Stealey of JP Morgan Asset Management as politics shakes up European bonds. We begin with our top story. Stocks heading steady ahead of tomorrow's big event. Omar Aguilar of Schwab writing this. We expect a slowdown in consumption and hence expect growth and inflation to subside in the second half of 24, opening the door to Fed easing. Omar's with us around the table for more. Omar, good morning to you.
Good morning.
What kind of Fed easing are you and the team expecting this year, and how big a difference is there between 1 and 2?
Well, I think in all these specters, always, what the Fed thinks and also what the market thinks. And it's just a matter of how this gap, works together. I think the market seems to be pricing in 2. And we believe that, the data will show that at least there's going to be 1. The question is going to be September or December. And I think September is the bigger question mark. And a lot of that will be a function of 2 things. One is going to be unemployment, and the other one is going to be inflation. So I think the 2 are competing with each other. On one hand, we see that trends in inflation are exactly where the Fed wants it to be. I think we're probably going to see some of that data tomorrow, where the trends continue to point towards that lagged effects going to deflationary that allows them to have that, flexibility they seek. And that will actually put them, in the right path for having 2 potential options. The question becomes, whether or not, the economy is going to be stronger than what they expect, and therefore potentially, have them under 1 camp.
This is complicated matters for a lot of people who have come on this programme for a few reasons. Here's one. So bond managers and bond strategists have been joining Lisa, Anne-Marie and me for a number of months ago now, making the argument that they need to get out of cash, go out along the curve, because the yields available now won't be there in 6, 12 months because the Fed's going to start cutting interest rates. All heard the argument. Maybe it's intuitive, makes a lot of sense. How successful have you been getting clients out of low-fee paying money market funds and getting them out of cash and doing other things?
Not very successful yet. I think, the time lags of getting people to deploy cash has just begun. I think, we're starting to see, we saw that at the end of the tax season, this is in April, where you actually see movement in money market funds, mostly just because of taxes. But we're starting to see that people are starting to look for opportunities to deploy that cash. Now, the big question becomes, do you hold on for the next 6 months until you get that, increasing your reinvestment risk, which is the, key point that you just made, which, in many cases, clients are actually willing to hold on for at least the next 3 months to be able to start increasing duration. And the bigger question becomes whether or not that comes with credit or without credit. So credit exposure relative to what they want to have, we don't believe that is necessary at the moment. They can still increase duration, enjoy higher yields, go into intermediate, but still stay in the high quality part of the market without necessarily having to extend, credit, so that you don't necessarily have that, asymmetric risk that, credit brings.
I kind of understand why people would want to just clip a 5.25%, 5.5% coupon for the foreseeable future, especially without a clear path to, fiscal responsibility or potential lack of volatility. And with another $39 billion of 10-year treasuries being sold today at 1 p.m., there's another auction. It's my plug. But, all of these kinds of issues give people a real level of concern. How do you sort of make the argument that it's a valid trade to be made at a time where it doesn't seem like the economy is falling off a cliff and it doesn't seem like long-term inflation expectations are going down that dramatically?
Well, I think at the end, it becomes about, what is the opportunity cost of staying in, invested at 5.25. And I think if you believe that the risk premium continues to stay in areas that actually becomes attractive, as you see real rates starting to increase when inflation coming down and the Fed doesn't moving, really the opportunity cost on investing in cash, gets, a little more difficult to sustain. The second thing, which is what we were saying before, is reinvestment risk. There is no question that with 1 or 2 or even more rate cuts in the next couple of years, as markets becomes more normal, the ability for reinvesting at 5.25 on the short part of the curve is not going to be available.
Reinvestment risk is an interesting idea, especially at a time where it seems like the biggest risk is not being in NVIDIA. I mean, essentially everybody comes on and they say, our equity exposure and our credit exposure, NVIDIA. And then cash. I mean, that sort of seems like the, takeaway that I get from a lot of people who have very complicated macroeconomic frameworks. And then it comes down to NVIDIA and clip your coupons. I mean, what's your argument against that versus really betting on any of these macroeconomic trends that have just seemed like a black box?
Well, it all comes down to what is your sense of, investing and the duration of your investments. On one hand, investing in equities, particularly in any part of the equity market, you obviously have a long-term view of what you think you're doing with those earnings projections. And if you believe that any of the top, 7 names in the index is going to continue with the level of earnings power that they have, that's a long-term investment you have. You're putting a long duration, bet on it. On the other hand, you're basically looking at the curve on fixed income, which is a short-term, piece, and it's blending the two. What basically matters, and as I said earlier, it only matters when you actually think that there's a risk premium that you actually want to take advantage of.
Omar, as you know, pre-pandemic, people gave up on bonds for income. A whole generation of people. There was no income there. There was no yield, particularly over in Europe. Have we reset things? Have you seen attitudes change and reset over the last few years?
I would probably say it's not the last few years. I think it's been the last 6 months where people started to realize that there's a great set of opportunities to be in fixed income that we probably didn't have for 15 years. And, parts of the part is like now you actually have a total return in fixed income that becomes attractive, relative to, what we used to have pre-pandemic.
So PIMCO might be talking his book here, but they were on the program just last week. I'm sure you saw them making the argument, the new 60-40. This time it's 60 bonds and 40 equity. What do you make of things like that we've had this sort of generational reset of yields, that the compelling case going forward from here is really quite good?
Well, I think, the different parts of the risk premium that you actually have will still suggest that it's still 60% equities, 40% fixed income. It's very difficult to actually change that makeup for that level of risk profile, especially given the next 5 years where we're probably gonna see these real rates that stay in that 1.5 to 2%. So when you actually think about that, and you think about the notion that we're gonna go to probably a more normal times, and that's maybe a little bit of part of the process where the economy is gonna grow at a normal pace, where we're going to see, business cycles are going to be a little more normal. We're going to have less of an impact of the big pandemic we have or the big financial crisis we have back in 2008. Now we're basically going to this setup where there is enough investing opportunities that includes fixed income, that includes cash, and that includes international, that for the longest time has not even been a possibility because the U.S. has basically performed much better than any international markets.
We've heard from a lot of people that in the past 6 months, you have seen, actually the past couple of months, you've seen a real swing in sentiment by investors to a more FOMO kind of bullish tilt. Is that what you're finding, that they're looking to take more risks, that they're more open to some of those sort of reinvestment concerns and not just sort of staying harbored in the mattress?
In general, yes. The optimism regarding, investing continues to just, grow. A lot of that is availability of information. A lot of that is ability, for people to open accounts. A lot of this, has to do with that. It is interesting because generations change. When you see Generation X and baby boomers continue to be incredibly invested and they love to just be in the market, the younger generations is still going into the process, but they are starting to invest early. So they're not as bullish and as optimism as the older generation, but at the same time, they ended up starting investing earlier in their lives.
Omar, this was great. It's good to get an update from you as we still wait for those people to sort of get out of cash and get out along the curve, right? Waiting for those cuts.
I mean, this idea of what reinvestment risk, and I think Omar put it well, which is until they can understand that there actually is a reinvestment risk, what's the problem? And right now, there isn't much for about $6 trillion of assets.
More debt coming a little bit later. Lisa might have mentioned 10-year. How much?
It's $39 billion.
Sort of snuck that into that conversation, yeah.
Oh, you noticed.
More
I just
supply.
wanted, come on.
Coming later on.
Yesterday was interesting.
Yeah.
The auction was actually compelling. Today it will be too.
Do you want to tell us why?
Yeah, because it was soft, and it was a 3-year auction, and it tailed, and it really had a pretty negative takedown. It basically had one of the lowest non-dealer take-ups in a while, and it was, it shows a certain degree of skepticism.
We'll see if the 10-year is equally as entertaining a little bit later. More buybacks for you too. This from General Motors, the board approving a new $6 billion share buyback. GM saying they're growing and improving profitability of the EV business. The CFO saying they're very focused on profitability of the internal combustion engine business as well. GM, Lisa, up by 0.9%.
They've been playing catch up actually in a pretty big way, especially after a lot of people valued them just as a car company and one that was almost left for dead for a while. They've got some catch up to do at the same time that Tesla's been, how much has it lost this year? Some 30%?
Yeah, something like that. I'll bring you the actual number in a moment when I can get it up on the screen quick enough. Just getting this next headline from GM. They report second quarter final results on July 23. That's the latest from General Motors this morning. More on that a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Donald Trump will meet with Senate Republicans on Thursday in an effort to plot out his priorities if he wins a second term in office. Senate Republicans hope to win a majority in November, which would give them the power to push Trump's legislative priorities and cabinet picks. Trump has a busy schedule. He'll also be participating in a meeting with CEOs hosted by the Business Roundtable. Former Archegos boss Bill Hwang faced blistering testimony in court on Monday. Hwang's former top trader told a jury that he was told to do the opposite of what a normal fund would do, including committing financial crimes, manipulating markets, and lying to banks. He went on to say that Hwang told his traders to maximize the effect on share prices at all costs. Hwang and his co-defendant have pled not guilty and are in the fifth week of testimony against them in their trial in Lower Manhattan. PIMCO says that more regional bank failures are on their way. John Murray, the head of global CRE, said the real wave of distress is just starting and that lenders still have a very high concentration of troubled commercial real estate loans on their books. Murray also pointed to U.S. debt funds, where more than $200 billion of loans are set to mature through 2025, which he says will struggle to refinance with higher rates. And that's your brief, John.
Danny, thank you. And just getting that confirmation, negative 30.06% to be precise.
Thank you. I appreciate the clarification.
Anytime. You knew that already.
Well, you know.
Up next on the program, the U.S. waiting on one vote.
I met with Prime Minister Netanyahu last night, and he reaffirmed his commitment to the proposal. Everyone's vote is in, except for one vote, and that's Hamas. And that's what we wait for.
And that's the conversation we'll have next, live from New York City this morning. Good morning.
Wednesday, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
This just in, I've got to share it with you. It's one of my favorite statistics that comes out of Bank of America and the Bank of America Institute, led by Liz Everett. The stats on bank balances and savings, the data that they have. So this month they looked at balances by household through the lens of age cohorts. Listen to this, Bramo. Every age group is up at least 44% since pre-pandemic levels. Big outlier. Gen Z, up more than 137% of pre-pandemic levels.
Well, yeah, in part because it was a low bar. They probably were, a lot
Granted.
right out of college. But even still, those were the jobs that saw the biggest wage gains. And we saw that during the pandemic. And, maybe that will be the reason why they're the entrance into the new market, which is what Omar was just saying.
Yeah, it's pretty amazing. Savings and checking balances for all age cohorts. Every age group up at least 44% since pre-pandemic levels. More on that a little bit later. Equity futures right now slightly negative. We're down by 0.4% on the S&P. We're down by 3 basis points on a 10-year, 443.55. Under surveillance this morning, the U.S. waiting on one vote.
All of the hostages, but especially our 8 American families who have loved ones in Gaza, we are determined to bring them home. The proposal that President Biden put forward is the best way to do that. I met with Prime Minister Netanyahu last night, and he reaffirmed his commitment to the proposal. Everyone's vote is in, except for one vote, and that's Hamas. And that's what we wait for.
So here's the latest. International pressure growing on Israel and Hamas after the UN Security Council unanimously passed a 3-phase US-backed ceasefire plan for the Gaza Strip. The plan calling for the release of all hostages in exchange for Palestinian prisoners in Israel, the return of displaced Gazans and the withdrawal of IDF troops from Gaza. Joining us now to discuss is Aaron David Miller of the Carnegie Institute for Peace. Aaron, in some ways, Secretary Blinken makes it sound quite straightforward. We wait for one vote, that's Hamas, and that's the vote we wait for. How do you see things?
Traditionally, Middle East negotiations have only two speeds, slow and slower. And this is not a normal traditional negotiation. The principal Palestinian decision maker is ensconced in a tunnel somewhere below Khan Yunis or Rafah, or maybe even in a tunnel in Egypt across the border. And you have indirect negotiations going on with the Qataris and the Egyptians, each with their own motives. And then, of course, you have Israeli politics. So I think the sequence is clear, but we'll see where it goes. Hamas is either going to produce a clean yes, unlikely, a yes, but that's reasonable, that may force the Israelis and the Americans to do additional negotiation, or a no. And a no, of course, would make it much easier for the Prime Minister of Israel, who I think really is not interested in a complete implementation of the president's proposal, to basically continue to maneuver, buy time, and watch this thing play out.
Aaron, to that point, let's say the answer is yes. Do you think that Benjamin Netanyahu would go through with it?
I mean, he's going to have to present, if it's a clean yes, and it's hard to believe in any negotiation, a clean yes, but let's say assuming Hamas says yes, then it's going to have to, it's already been endorsed by the War Cabinet, which may or may not exist now since Benny Gantz has left. It'll go to the full Israeli government, and the two most extremist parties basically have said, we will not accept any part of this proposal. So if in fact it's presented to the government and they say no, then there are two possibilities. Either Yair Lapid, who's already publicly said he would give Netanyahu a safety net to go forward, and you'd have a sort of disunity government for the next several months, or alternatively, the government falls, presumably, and you'd end up with new elections in 3 months.
On a broader level, Aaron, you've been covering the Middle East for decades. You've been watching events transpire. It strikes me that this is a particularly intractable situation, and one that has sort of changed the social fiber and the political dynamic in ways that we really haven't seen before. How do you understand how the conversation has changed, not in terms of in the Middle East, but also in the United States around this issue?
Look, I think you've got a situation in decades of working in the State Department and following this issue, never have I seen any Middle Eastern issue provoke the kind of controversy and domestic turmoil that this one has. And I think in an election, which could be contested by 3 states and under 100,000 votes, any impact, any event, including Gaza, the uncommitted, those who won't vote for the current president or won't vote at all, could have an impact. I think the domestic climate here politically is also very fraught. You have a Republican Party that has emerged as the Israel Can Do No Wrong party, and you have a Democratic Party that's deeply divided on what kind of Israel mainstream Democrats and progressive Democrats are prepared to support. And against the backdrop of all of this, of course, you have the Prime Minister of Israel, highly controversial, due to address a joint session on July 24, besting Churchill's record of 3 addresses to a joint meeting or a joint session of Congress. So it's become a political issue, a fraught one in a way I think it's never had this sort of impact before.
Aaron, there's been a lot of focus, certainly on a number of big companies, on the role that a lot of universities have had in this. We don't have a lot of time, but in a minute, can you give us a sense of whether you continue to expect universities to sort of produce some of the protests that we've seen recently?
I mean, it's really hard to know. These protests came out in May, toward the end of semesters. Will they have the sort of impact in residents again in September? It's really tough to say. But again, I think you've got a situation where the Israeli-Palestinian conflict has basically created an opening for any number of laments, complaints, and ideologies. And I think that's, frankly, quite dangerous, because the way this conflict is not a morality play between the forces of goodness on one end and the forces of darkness on the other. It's a very complicated conflict in which both sides have competing needs and requirements that need to be met. It's really Goethe's definition of a tragedy, I think. 2 competing justices. I only wish that the political dialogue in the United States could reflect that sort of pragmatism and balance, because maybe we could create the kind of political consensus that would help, at least on our side, resolve this rather than exacerbate it.
Well, we appreciate this dialogue this morning. Thank you, sir. Aaron David Miller there of the Carnegie Endowment for International Peace. More still to come from New York. This is Bloomberg. Equity futures on the S&P 500 negative here by a third of 1%. On the Nasdaq, we're down a third of 1%. Also on the Russell, the small caps underperforming. Seen this quite a few times. We're down by 0.75% on the Russell this morning. In the bond market, 2-year, 10-year, 30-year, here are the scores, and then I'll get you some commentary. On a 2-year, we're down about 4 basis points, 484.25. On 10s, we're down 3 after climbing for 3 consecutive days coming into Tuesday. We're getting back to about 443.94 on a 10-year. This from Andrew Holdenhorst of Citi. Dovish risk going in tomorrow. That is not what we've heard at all from the consensus. Andrew saying Powell may lean dovish. 272,000 new jobs, an upward revision from 2.6% to 2.9%. Q4 core PCE inflation present what could be seen as a hawkish backdrop for this week's FOMC meeting. Team goes on to say, but a rising unemployment rate, falling job openings and slowing inflation, including what they project to be 0.26% month-over-month core tomorrow morning, mean we see more dovish risk at tomorrow's FOMC meeting.
2 comments. Number one, probably a fair guess considering that Jay Powell has gone dove pretty frequently. It's sort of a normalcy that we see the statement and it sounds fairly balanced. And then Jay Powell comes out and he basically is like, no, we want to cut, and everybody rallies. So that's fair. On the flip side, there also is this point that Andrew Holdenhorst and the team did push that cut back to September from July. But their base case has not changed. They still do think there is going to be a really significant weakening in the labor market. We just haven't seen it yet.
Well, depending where you look, because parts of Friday we have seen it. Other parts we really haven't.
It's so frustrating. I got to say this. And I like this idea of narrative fallacy, where everyone's trying to create some sort of bigger story around each individual data point. That's the reason why we're all running around like chickens with our heads cut off.
Well, let's keep running around like chickens with our heads cut off, which is kind of like this show at the moment. Let's turn the page and take a look at what's happening in European markets. So the euro's weaker again by a third of 1%. French equities are down another 1.2%. Bond yields are higher now by another 9 basis points. I think the takeaway for me this morning, just waking up, just having a sneak peek of what was developing in Europe a little bit earlier this morning. Lisa, this hasn't settled down from yesterday in France. It really hasn't. The trend has continued.
And why? Because we weren't surprised by the outcome of the European elections, right? A lot of people had been expecting this. Sure, there was a little bit more of a tilt to the right, but otherwise it was pretty much in line with the polls. There is a realization that politics matters. And as much as people don't want to think about it because it's something that is totally uncontrollable and unpredictable, it is something with profound implications. And they're seeing that across the Euro region. What I find interesting is that both Italian bond yields as well as French bond yields are surging relative to German bond yields. Why? Given the fact that Germany is seeing the same kind of wave, if not more so. So it's sort of, there are a lot of questions embedded in this data about what the knee-jerk response is to just this feeling of uncertainty.
Yeah, I think consensus view of the people that come on this show, I think they've wanted to ignore the politics this year. More specifically, they've wanted to ignore what's developing in November this year. I just wonder how close we are now. You were putting your hand up because you were one of them, right?
Yeah, exactly.
Yeah, I just wonder how close we are now to actually just saying, I don't think you can ignore it anymore, the deeper we get into summer. And I would say the starting gun for that, for me at least, is the end of this month, the debates start, and then it's just impossible to ignore.
But the issue is people aren't ignoring it. They're talking about it. But what do you do with it? I mean, this is really the challenge. How do you hedge? And so that's why you are seeing more hedging. We can get a number of people on to talk about that. Amy Silverman's talked about how there is sort of a gapping out in some of the options trading to highlight that nervousness. I just wonder, how do you prepare? Well, how do you even understand what the market reaction is to potential policies and what the candidates will say or do between now and then?
You know what the conclusion is? T-bills and
NVIDIA.
Yeah, there you go.
That's what you do.
It's like the conclusion to everything at the moment. Under surveillance this morning, investors looking ahead to tomorrow's doubleheader. We'll get CPI at 8:30 Eastern time, followed by a Fed decision at 2 p.m. Investors widely expecting, also looking towards the so-called dot plot for clues on the Fed's path forward. Elsewhere, crude holding steady after posting its biggest single-day jump since March. OPEC releasing its monthly report, expecting strengthening oil demand in the second half, the same time frame that it plans to hike supply. Crude a little bit lower again this morning by 0.2%. And finally, Apple's big AI reveal leaving a sour taste in the mouth of some. The company announcing ChatGPT is coming to its devices later this year. Elon Musk responding, saying he'll ban Apple devices from his companies if the open AI software is integrated into the iPhone maker's operating system. Tom Forte of Maxim Group writing this. Consumers feel like they have new phones when Apple updates its mobile operating system. To the extent it rolls out its AI-related efforts in a way that breaks that bond with consumers, that could result in backlash for the company. Tom joins us now for more. Tom, I just want to start with that point. In what way would that break its bond with consumers? What's your view on that?
There's two real risks to Apple's brand on Apple Intelligence. One is what I wrote there, which is when you buy an iPhone, you get that new iPhone feeling every fall when they roll out the new mobile operating system. So if Apple's saying, this Apple Intelligence is really cool, which remains to be seen if it is, but you need to have an iPhone 15 Pro because the chip on your iPhone 15 is not adequate to do it, then you do not get that new iPhone feeling every time they upgrade the software. And I think they're breaking a bond with the consumer. The other risk to brand is that they've named it Apple Intelligence. So if we use Siri as a guide, Siri's kind of been a failure to the extent that my own anecdotal use of Siri is a glorified egg timer. So to the extent that now I'm going to rely on Apple Intelligence and Siri for all this supposedly wonderful artificial intelligence, I think there's a lot of brand risk for Apple in the move here.
Tom, this is interesting because we caught up with Dan Ives, and I wish we'd formed a panel with you both a little bit earlier this morning. Dan Ives of Wedbush earlier today was saying this is it. This is going to be the thing that unlocks that elusive upgrading cycle, that mega upgrading cycle we've been looking for years now. Dan says it's just around the corner based on what they released yesterday. Why is he wrong?
He's wrong because I think that artificial intelligence is not ready for prime time. When you think about hallucinations, you think about the many issues that Google's had with Bard, and then now integrating with ChatGPT. Consumers are going to get a lot of bad information. It may not be have a rock every day or, include the glue when you make the pizza to keep the cheese to stick, things of that nature, and it may be. So I think that I understand why Dan thinks this could be the elusive upgrade cycle, the first major upgrade cycle since 5G, but I'm not convinced that we're there yet.
Tom, just to put a bow on this, basically we heard from Dan Ives that he will wear a black suit if they don't get the kind of increase in sales. Will you wear Dan Ives' wardrobe if they do see that increase in sales come September?
I will wear his most obnoxious, boldest colored outfit. We could go Knicks, blue and orange, even though I'm a Bulls fan. Absolutely.
All right, we will be there for that. I will wonder, just going forward, you said something that I found really compelling, that this is breaking a bond with the consumer. There has been a feeling that if you had an Apple phone, if you had an iPhone, you would be a subject of whatever kind of new advancements were coming out for the phone specifically. You think that this is actually going to cause people to turn away from the iPhone. Is that correct? Or else just keep their old ones?
I think there's real risk here that the consumer will be less enthralled to continue to buy smartphones from Apple if they don't get that new phone feeling every fall when they upgrade the software. So, yeah, I think that's a real issue.
Where do they go? And I guess this is why we saw Samsung kind of trolling Apple yesterday, putting this out. Adding Apple doesn't make it new or groundbreaking. Welcome to AI, followed by an Apple emoji. This was Samsung's official account, putting that out there on social media. Do you think that Samsung wins out here if they introduce something that's more polished, more advanced, and frankly diverges more significantly from what's currently available?
Well, I think Samsung could win out to the extent that a consumer dissatisfied with the Apple experience, either because of Siri or Apple Intelligence or things of that nature, may gravitate to Samsung. So yes, but at the same time, I think that the AI issues are kind of industry-wide. There's hallucinating on Samsung phones as well. But yeah, I think you might see some switching here if this bond is in fact broken.
Hey, Tom, this relationship with Google is interesting. You're one of the few that's really, really digging deep and talking about it. I assume we'll be spending lots of time doing other things and less time on Google search. And I'm trying to work out if that's sort of good for Apple and bad for Google or bad for both.
I do think that bad for Google is a fair interpretation of yesterday's news to the extent that they're integrating ChatGPT although they did open it to other large language models, including Gemini from Google. But yeah, I think that the challenge for Google in search is to the extent that Microsoft integrates OpenAI's technology and to the extent that consumers lean into artificial intelligence to advance search despite the challenges, that could be a real issue for Google.
Not just Google. There was an issue for a lot of apps and app creators that came out. I'm thinking of Grammarly. I'm thinking of some others. There was sort of a list of RIP, all of these different apps yesterday trending as people took a look at what would be rendered obsolete by some of this technology. Do you think there's going to be a real tension, particularly with Apple's dominance in the App Store, between some of these app providers and, frankly, the fact that they've been rendered obsolete overnight?
Absolutely. The number, though, that stood out to me yesterday is that there's only 2,000 native apps for the Vision Pro. So that feels like a low number 1 year into the product. And it reminded me on larger scale of the flashlight app. So there was a point in time where if you wanted to use your iPhone as a flashlight, you had to get a dedicated app. Now it's a feature within iPhone. So yeah, I think there's a lot of risk of irritating the developers here as well.
Tom, just finally, we'd love your view, just to finish up. I want to hear a little bit more from you on Elon Musk and that complaint from Elon. What did you actually make of that? Do you actually think he'll follow through with that?
I do. And so I admit, though, I'm only halfway through Isaacson's book on Elon, which I'm enjoying immensely. But I do think that Elon, while he may crave drama, I think there's a lot of validity into his comments. And I worry about the consumer who flip-flops between Apple Intelligence and ChatGPT, one that's supposedly privacy protected and the one that's open and doesn't know better. So I think, there's going to be a lot of fun stories. The good news is now we have Apple strategy. Now we get to see how it works out.
Interesting. Tom, looking forward to the results. Tom Forte there of Maxim Group. Someone's going to wear the suit they don't want to wear, right?
Oh, I can't wait for this.
It's
I'm actually,
Dan Ives in a black skinny tie and a black suit, or it's Tom.
He didn't say skinny
in
tie.
Orange and blue.
Are you going to supply?
I'm dressing him.
You're going to be his sartorial.
He knows this.
Consultant. Yeah. You're going to basically give him something and he's going to come out here with this feeling of shame.
Something like that. You're on the money, though, by the way. What this makes obsolete. It's going to be very interesting how quickly that happens, too.
Well, at a time when you hear Washington, D.C. dialing up the pressure on Apple and kind of how dominant it is to either make or break so many different innovative upstart companies, right? There's going to be more discussion about that. And we heard that just now from Tom Forte, this idea of the flashlight app. I mean, I don't even remember that time period because I just, press. Who doesn't use their phone as a flashlight?
That flashlight comes on accident all the time.
I know. But
when did you put that light on deliberately? Come on.
Yes, I always put it on deliberately.
Comes on, do you? What for?
Yeah, for looking for things.
Oh, right.
Taking splinters out of people's feet.
Oh, right, okay. That makes sense. This is like a household device for children.
Let's just move on.
For sons getting in trouble.
Correct.
Okay. Apple, negative by a third of 1% in the pre-market. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A check on General Motors shares up 1% in the pre-market. They announced a board-approved $6 billion share buyback just moments ago. GM also said that it's focused on improving the profitability of its EV business. Full results for the second quarter come on July 23rd. Donald Trump has met with his probation officer for the first time yesterday, virtually, with Trump in Florida and the officers in New York. It lasted for about 30 minutes. The meeting will help a judge decide how much time, if any, Trump will spend behind bars for falsifying business records. Sentencing for the former president is set for July 11th. Trump and his legal team are already taking steps to file an appeal. And a New York City office building owned by a related affiliate is set to be sold at a steep discount. Empire Capital and Amdar agreed to purchase the property at 321 West 44th Street for less than $50 million, according to people familiar. That's a roughly 67% discount from what was originally paid in 2018. That's your brief. John.
Brutal. And maybe more of that still to come. Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, taking on risk in Europe.
There's coming a point where European bonds are more attractive than Treasury bonds, in my opinion.
We'll talk about that opinion next. Live from New York, this is Bloomberg. Running you down to the opening bow this morning. Good morning to you. Equity futures on the S&P 500 just a little lighter, softer, negative, down by 1/3%. A rally in the bond market. Yields down 3 basis points on a 10-year. In the US, we're down to 443.35. You're not getting that rally in France, I can tell you that this morning. Yields are much higher once again on the session over in French trading. Under surveillance this morning, taking on risk in Europe.
I think in terms of an attraction, German 10-year bunds and French oats, the 10-year there, their spreads have narrowed significantly in the past month or two relative to treasuries, and today as well by 8 or 10 basis points. So there's coming a point where European bonds are more attractive than treasury bonds, in my opinion.
Quite a take based on the price action of the last 24 hours. Here's the latest. French bonds tumbling, on track for their biggest two-day loss since 2020, as the fallout from Emmanuel Macron's decision to call a snap election continues to rattle investor confidence. Iain Stealey of JP Morgan Asset Management saying this: ultimately, French bonds have been impacted with the uncertainty and would indicate other parts of Europe, like Spain, will become seen as better credits. Iain's with us around the table. Iain, good morning to you.
Good morning.
What is it about this? Can you just explain in very simple terms, what is it about calling a snap election in France that's leading to a reaction like this over the last 24 hours?
So ultimately what we saw over the weekend was we had the European elections. We had a swing more to the right than had been expected, particularly in France. So Macron has come out and said, OK, if that's the case, let's have an election on this. And the concern from a market standpoint is that the right wing, the RN party, actually do gain more seats, and ultimately they are tax cutters. They want to spend money. This is France that had a deficit of 5.5% last year, total debt to GDP well north of 100%, downgraded by the rating agencies not that long ago. And the market's basically just concerned around it and saying, hold on, if that's the case, why don't we look at other parts of Europe?
So where's the deficit now? Close to 5.5% GDP?
5.5%. And
something like that?
Under European legislation, they need to start bringing it back towards 3%. And that's obviously going to be challenged under this scenario.
France is starting to look more like the periphery.
And if you look at what's happened over the last couple of days or so, you've again seen a tightening. I think Spain's something like 18 basis points higher now than France. And obviously that's significantly tighter than it was not that long ago.
Does it make sense, though, that the yields on, say, French bonds and Italian bonds are jumping up, gapping up relative to German bonds, where essentially they're facing the same type of political threat?
They are, but obviously Germany haven't called the snap election. And also you still see Germany as the safe haven asset within the whole of Europe. I think Italy has been impacted somewhat by effectively just sort of dragged around by what's happening in France. And also Italy is a very favourable positioned market earlier this year just because of the additional spread and yield that you're getting on those markets.
To zoom out and sort of go to where we began with Bill Gross, where he was saying basically he sees European bonds as a better buy than the U.S. debt. A lot of people have been sort of arguing that Europe looks more favorable just simply because the ECB cut first. They seem to be on a rate cutting cycle before the Federal Reserve. Do you buy into that more broadly, despite some of the internecine issues that we've seen over the past couple of days?
I think it's a really interesting question because actually if you look at what happened last week, I think it's a legitimate question is would the ECB have cut rates with the data set that they were looking at had they not pre-announced it a few weeks ago? And I think that's a really good question that is quite, Lagarde says yes, I'm not so sure. So when we look at the European data at the moment, there's definitely sort of green shoots coming through. And actually, when you look at some of the US data, you could argue we are maybe seeing a sign of softening. So I'm not certain that we're going to have a massive divergence between Europe and the US if you take sort of a longer 12 to 18 month period.
Let's run with a single word, convergence or divergence. Which one? Do you see convergence between the two?
I think over a period, I think you do see convergence. Obviously the Fed's late to the party and sitting on the sideways fashionably. But, I think they are going to come to the party.
What do you think that means for US bonds relative to what's developing in Europe?
I think what you're going to see is you are going to see the bonds will be dictated by what the central banks do. So then we are back to basically data watching and checking out what happens on inflation prints. Obviously, big one tomorrow. But I see actually US yields looking reasonably attractive on a 12-month time horizon.
You say data watching. Actually, that's not what we're looking at all. What we're looking at is a building at 321 West 44th Street in Manhattan. I think Lisa indicated a little bit earlier this morning, PIMCO. What are they warning about now?
Oh, they're warning that a lot of regional banks are still going to fall apart because they are lenders, massive lenders, to a lot of commercial real estate and office space that is yet to really fall out of bed.
So should we be watching inflation or commercial real estate? Which one?
I think in the near term, you want to be watching inflation. That's effectively what the market's focused on. I think longer term, and I think this is what Jerome Powell and the Federal Reserve are looking at, is they are still concerned about these long and variable lags. They've been longer and maybe more variable than people have been expecting. But we still have had 525 basis points of rate hikes. And ultimately, we still don't know what the exact impact of that's going to be. So I think that's what Jerome Powell is saying, is hold on, we've done a lot. You know, at some point, there are going to be some cracks coming through the system.
I guess this goes to this broader question, and you'd be perfectly positioned to really answer it. And the reason why we bring up commercial real estate with the long and variable lags is because a lot of people said it is improbable, if not impossible, to raise rates this much in the United States, in Europe, without something breaking. A lot of people have said we see the all clear and have been piling into credit. At what point is there a credit risk at a time when we really just haven't seen those cracks? And it seems like a lot of the bigger companies have done just fine. They've refinanced. Everything is hunky-dory. But elsewhere, there certainly are signs of some serious stress.
There are, and definitely some of the lower credit qualities. And if you look at sort of, you know, there's been a big divergence within the high yield market where, yes, the high yield spread on average looks pretty low, but there's still a sort of a 5% bucket, which the market is saying there's some trouble in that space, and they're trading at over 1,000 spreads. I personally think high quality investment grade yields are looking pretty decent, even though, you know, spreads are tight. Fundamentally, we see corporates in that area as very robust at the moment. So I do think that people are focusing on the all-in yield and not so much looking at the spread on that part of the market.
You're in New York. Yep. You're normally in London. You're here for the quarterly meeting where you discuss and you hash out all sorts of potential investment views. How much conviction do you have this time around?
I think there's a lot of conviction in my mind that we've got a very reactive central bank set at the moment, who at the first sign of weakness are going to be looking to effectively ease policy. That's what I've heard from all the central bankers really since the pivot in December, is that they have done enough. They feel that they're in restrictive territory. They really do want to ease policy back down again, and they're just waiting for the green light to do that.
On the surface, this might sound like a silly question, but to some people it might sound quite relevant. Do you think the first sign was Friday at 8:30? Do you think we look back on that and maybe see that as a first sign of weakness in the labour market? Are we looking at the right survey, asking the right questions?
I think, obviously, job headline number, very good. But actually, if you look at a lot of the survey data that's been happening over the last few weeks or so, whether it's JOLTS, whether it's a small business hirings, whether it's some of the surveys out of the New York Fed about people concerned about losing their jobs, you know, temporary workers as a percentage of the workforce falling. These are all signs. I think weakness is probably too soon. Softening is definitely the right word. And I think it's going to be very key as to whether we continue with these high headline prints or whether actually some of the other data is going to show that we are starting to see a bit of softening.
Mike Apin said the same thing over at Bank of America. What was it, cooling but not cool?
Yeah.
So something like that.
Which is the reason why I didn't see a rate cut until much later this year. And he felt pretty good on Friday.
When was the last time that we had a jobs print this strong and afterwards saw such widespread scepticism about it? Because usually there's someone in the corner sort of making noise about, you know, it overstates the strength of the labour market, and you're like, yeah, all right, OK. And you always hear those kind of voices. But now it's like pretty much everyone I've spoken to is kind of asking the same question about Friday's data.
First of all, it completely conflicted, the household survey versus the other. Second of all, we're conditioned by experience. How many other downward revisions have we seen from pretty big numbers in the past year or two? And this is clearly messier data to get. That's, I think, what's creating some of this skepticism that's borne out to be somewhat correct, not nefarious, not necessarily conspiracy theory stuff, but this has been a tough nut to crack.
You know what TK would say about the news conference tomorrow, right? There's going to be a sheet of paper for Chairman Powell. It's going to have the, answer to any question on the labour market, and he's just going to read it verbatim. Because that's where there could be some trouble. His interpretation of what Friday actually was and where this labour market is.
I think to Ian Stealey's point, this is a central bank that wants to cut, and he's talking more globally about all the central banks, but I think you could say it very specifically to Jay Powell. This is a man who wants to cut rates, who is very concerned about some of the K-shaped kind of divergences, and we've seen that pretty much consistently when he's supposed to do hawk, and instead he's just can't resist the dove.
Lagarde clearly wanted to cut so much they cut. And now we're all asking whether they should have. Ian, this was good. Thank you, sir. Ian Stealey of JP Morgan Asset Management. The next hour of Bloomberg Surveillance looks a little something like this. Alicia Levine of BNY Mellon. This conversation with Bill Chappell of Truist is going to be fascinating. what was it? Krispy Kreme.
Yeah, Krispy Kreme and Ozempic.
Why we've sort of like seen the GLP-1 scare.
Yeah.
And we need to move on.
And now go all in because people are going to go back to Krispy Kreme, especially with a partnership from McDonald's.
Okay, that conversation just around the corner. Mark McCormick at TD and Stephen Stanley of Santander joining us as well from New York City. This is Bloomberg.
I think we're in this sort of phony war right now where there's just a lot of uncertainty on the data.
I don't want to overreact to 1 month's number. If our base case is that economic activity is slowing.
You just really need to pay attention to valuations in a way that we really haven't had to.
The economy is still chugging along.
Why sacrifice the economy to the altar of a 2% inflation target if you don't need to?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance begins right now. And at some point this morning, Chairman Powell's waking up and getting ready for a two-day meeting down in Washington, D.C. Concludes tomorrow. Tomorrow morning, though, we get the big one. CPI, 8:30 Eastern Time. Speak to a lot of people this morning already. Like 8:30 is bigger tomorrow than the Fed decision at 2 p.m.
Oh, sure. Mike Schumacher saying that also. I mean, basically this idea that if we do see some sort of stickiness to the inflation or upside surprise, you could see a pretty big move. If you see a downside surprise, you could also see a pretty big move because we're all playing this sort of narrative fallacy, as Steve Major said, which is basically looking for how to put the tea leaves together in a way that gives us an edge in an edgeless world right now.
Operating around some really fine margins. I think there is just the belief that at 8:30, when that CPI number drops, it shapes the decision they make, not going forward, but the projections that they'll put out at 2 p.m. Now, I just wonder to what extent that's actually true, but that seems to be the view on the street, that we could have a difference between 2 cuts signalled in that median dot and 1 based on what CPI actually looks like. And I imagine they've already got the data anyway and they can figure that out.
We're actually going to be live on the ground tracking their progress as they get it. And we'll get tea leaves about how shocked they are and just how much they massage. We're not actually, that's a complete lie. But basically, that's what everyone's going to try to do to get into their heads to try to understand how much that really does change things. Arguably, it shouldn't at all, because arguably they've been talking about several months of data and not one print is going to really alter their views. It's not as though they're going to suddenly hike rates if inflation goes to 1% month over month. I mean, they're not going to do that. They're going to look at the data and they're going to say, well, what kind of skewed this? I think a bigger question is going to be, where is the balance of risks and the 2 dots or the 1 dot? And is Jay Powell waking up this morning? Is it 1 dot? Is it 2 dots? I don't know.
Going to make him do 1. Going to make him do 2.
I don't know. It's stressful.
It is stressful. For him, not for us. It's easy for us because we just get to sit here and ask questions. He's got to try and answer them.
I know.
And in the news conference, he's got to try and answer how he views the labour market right now based on the data we had on Friday. And we've said repeatedly on this programme, I think that's going to be really, really tough for the chairman based on the 2 very different stories the 2 surveys tell you.
Especially because it's not just those 2 surveys. It's also all the other data. I mean, we were talking about how even some of the soft data is conflicting with itself. For example, we see signs of labor market softening, and then the U.S. small business optimism comes in at the highest level today, going back to the beginning of this year. So which is it? And it raises this question, where is the balance and how do you sort of get a mooring? I will just say, I did get a note this morning saying we need to keep watching the Treasury auctions closer. And
yeah, who is that note from?
It was Mohammed. Thank you, Mohammed. I will just say I'm on board with him. I do think that we need to be watching this for a gauge of just the nervousness, the sort of price discovery that we get at each of these debt sales.
Memo to Mohammed, who will be joining us tomorrow on the Fed programme.
It's a different Mohammed.
No encouragement is needed. It's a different one?
Yes.
OK, I thought we'd just call Alarian Mohammed.
Well, there are other people who are named Mohammed, just letting you know.
Really?
Yes.
Thank you. Thank you very much
No,
for the
somebody
update.
else, yeah.
I needed that. All right. Usually, if it's someone new and it's not a friend of mine, you use the full name.
Well, I know, but I don't want to blow his cover. You know what I mean?
All right. Well, thank you to the other Mohammed. There are 2 of them. That's amazing. Thanks, Felicia. I appreciate it.
Anytime.
There are things you don't know that you learn from Bramo. Equity futures on the S&P look like this. The score's shaping up as follows. We're negative by 0.25%. Yields are down by 4 basis points on a 10-year, 442.56. The euro just a little weaker here, down a third at 107. 29. Coming up this hour, we'll catch up with Alicia Levine of BNY Mellon on why she's constructive on the markets through 2024. Bill Chappell of Truist saying Ozempic is no threat to Krispy Kreme. And Santander's Stephen Stanley looking ahead to CPI data and the Fed decision. We begin with our top story. Stocks hitting new highs ahead of tomorrow's doubleheader. Alicia Levine of BNY Wealth saying this. Markets are pricing in a soft or no landing with a cutting bias at the Fed. We agree with this view and are constructive on markets through 2024. Alicia joins us now for more. Alicia, hello. Good to see you.
Good morning.
What would you expect from Chairman Powell in that news conference tomorrow?
So he's got to thread something really interesting because we're already at 4% unemployment, which, as you know, in the last SEP is where the Fed predicted for the end of 2024. So we're only, barely halfway through the year. And to move from a 3 cut to a 1.5 cut, let's split the baby and say 1.5 cuts. To go there, something has to change in the data that is consistent. So either GDP has to be ticked up a little bit or the inflation has to be moved up a little bit. And it doesn't have to be for 2024. It could be in 2025. So maybe PCE moves to a 2.3 from a 2.2. But it has to be consistent if they're going to go from a 3 cut to a 1.5 cut, right? They can't keep all the other numbers the same. And so is the story slower growth, higher inflation, i.e. a little stagflationary, or is it growth is okay and therefore inflation's a little bit higher, so we're going to go from 3 to 1.5? And that's kind of the circle that the Fed has to square here. How do you tell your message? Is it a stagflation message, or is it a growth and therefore inflation's coming down more slowly?
So you've got a 2-part challenge.
Right.
The first part is what you actually just did. The second part is to work out what the market's going to do in response to that.
Right.
Are you convinced either way?
So first of all, talking about the labor report on Friday, I find it confounding. I still don't understand it, to be honest. And I suspect that some part of it is going to be revised at a future date because it's actually very hard to get
wrapped around. I'll ask you. You say some part. Which part?
It's hard to know. It's really hard to know. It's really hard to get fewer people in the labor market, therefore higher unemployment rate, and yet nearly 300,000 jobs on the top line, while the household survey is negative. The household survey is people working on their own, not at firms. But we've seen businesses start at the greatest rate ever in the last year in the country. So neither of those numbers make sense, is what I'm trying to say. So I suspect that's going to be a little bit revision. But let's move that aside. I think we're going to hear higher growth and stickier inflation. I don't think we're going to get the stagflation story from the Fed.
So at this point, what do you do with that? Right. I mean, basically everyone...
Stay long.
Stay long what? Stay long NVIDIA?
So look, we are constructive on markets because, as we've talked about here at this table, administrations that are running for re-election do everything to support the economy. So we're fine through the end of the year, although I think Europe, Mexico, and India are good examples of how elections could maybe provide some volatility towards the end of the year, and certainly we're the granddaddy of them all there. But ultimately, we're very positive because the earnings and the margins keep on moving up. That's the fundamentals. So as the fundamentals move higher, you stay long here. And so, there will be, I think, as we've seen from the beginning of the year, more volatility in the bond market than the equity market. The equity market has been remarkably calm this year. Barely a 1% move in either direction the entire year. Right?
So, but are bonds still in the ballast, right? I mean, basically, is it just cash and is it NVIDIA, or basically the tech behemoths that are throwing off a lot of cash? Is that the playbook in a time that you can't rely on the data? You can't gauge the macroeconomic backdrop, and frankly, you can't even gauge the response of markets to that.
Right. So, look, bonds are still the ballast. I think the issue of supply and the issue of the deficit is real, and it will become more real as we move past the election season, right? So I think this year we're fine. We have massive liquidity in the system. The Fed started the taper of QT. There's just a lot in the system to support liquidity and markets here. Then you have to get to 2025 in the conversation over what happens to the Trump tax cuts, right? And there are very different prescriptions about this, both of which will be inflationary. So, we're good through this year, and then we have to start thinking about where do the where does the puzzle, how does it work after the election? And that's really unknowable, right?
Isn't this really sort of like unconventional to forget about 2025? Just sort of leave it out there?
So look,
we get to November and we only start thinking about it then?
The fundamental side, we think, is quite strong. What will wind up happening around the election are sector-specific stories. So which sectors do better under what administration? And that's how you will see markets move. It's going to be less about the top line, less about the growth, because we think fundamentally the growth is good. That's our bedrock for the story. It's just which sectors will be more affected under which administration.
As we talk to a lot of investment managers, I'm struck by something that Ben Bowler of Bank of America had written in a recent report where he said the longer this kind of dynamic goes on, the more investment managers stand to lose out and actually lag behind in terms of their performance if they're not overweighted to a number of very specific stocks and if they're not in highly consensus positions that are already crowded. How fragile does that really make the market right now?
So it's uncomfortable. I mean, 3 stocks are 20% of the S&P. Think about it. We were crying when 2 stocks were 14% of the S&P, and now we've got 3 stocks at 20% of the S&P. So I wouldn't say it's fragile because these are the least fragile companies on earth because of the cash flow, right? So ultimately, you're looking at cash flow to provide the ballast, and of course, that's where the margins are as well. But stories change, and look at the dynamism in the economy. You know, the top doesn't stay the top forever. So we think for the near future, let's say we're in a cycle of investment in AI, this is fine. At some point, that markets change. Like, you can't think this goes on forever. It's very rare to have the top 10 be the top 10 the beginning of every decade for 5 decades. As we know, Microsoft managed to get back on it. But that's the exception, and that's why it's rare.
If it doesn't trickle out, the sort of dynamic backdrop for some of the big tech stocks, if it doesn't broaden out to other companies, is that going to sort of unravel it? Does it need to sort of broaden out in order to keep this virtuous cycle of investment? Or is it sort of the winner takes all kind of moment?
It feels like a winner take all moment, but that's okay on the index level. But in the end, the market is broadening out. We've seen industrials, we've seen discretionary start moving higher. And healthcare is starting to move again. We've got great innovation in the healthcare sector. Think of the data we saw what happened at the FDA because of Eli Lilly yesterday. That was great. I mean, we have innovation all over this economy. And I think to just focus on there's 2 stocks, there's 3 stocks driving it, and therefore we're going to cash. You're going to miss a lot of upside here. You know, we invest in innovation. This is the greatest country for innovation, and our stock market reflects it.
We'll talk about healthcare a little bit more in just a moment. Alicia, you're going to stick with us. Alicia Levine there of BNY Mellon. Your equity market a little bit softer on the S&P 500 with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The main shipping channel into Baltimore's port has been fully reopened. That follows the March collapse of the Francis Scott Key Bridge. It also follows a massive cleanup operation. Workers removed an estimated 50,000 tons of steel and concrete from the water. That wreckage left the port of Baltimore effectively closed for several weeks. Officials say that they hope to rebuild the bridge by 2028. Golden Goose and its shareholders are seeking to raise about 558 million euros in the luxury sneaker brand's IPO. That will give them an implied market value of up to 1.9 billion euros. Bloomberg had, though, reported that Golden Goose was hoping for a valuation at about 3 billion euros, a valuation the CEO told Bloomberg Brief at the time that he was happy with. Elon Musk says that he will ban Apple devices from his companies if OpenAI software is integrated into the iPhone maker's operating systems. He called it a, quote, unacceptable security violation. Apple announced that its customers would have access to OpenAI's ChatGPT service through its Siri assistant. The new features are set to be rolled out later this year. Musk, for his part, had co-founded OpenAI but had a falling out with the company, and he's currently working on his own competitor to ChatGPT. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. That stock is negative. Apple down by about 0.2% in the pre-market. Up next on this program, the Morning Calls Plus, Truist, Bill Chappell on why he says Ozempic is no threat to Krispy Kreme. More on that call on the other side. From New York City, this is Bloomberg. Stocks on the S&P 500 softer here by about 0.25% on the S&P, and the bond market yields a little bit low. We're down 4 basis points, 442.96. Let's get you some morning calls. First up, D.A. Davidson upgrading Apple to buy from neutral with a price target of $230. The analyst saying the new AI features unveiled yesterday will drive an iPhone upgrade cycle. That stock a little softer this morning. Your second call from Oppenheimer lifting its price target on Nvidia to $150 from $110. The analyst still seeing the company as the best positioned in AI after the 10-to-1 stock split. We're down 0.25%, which is a rare thing. I've said that twice in the last couple of days.
It won't last.
We'll see. And finally, Truist upgrading Krispy Kreme to buy with a price target of 15. Analyst Bill Chappell saying Ozempic is not enough to weigh on the stock as people still like their sweets. And in the GLP-1 overhang has largely played out. The stock's up 1%. Bill joins us now. Bill, great to catch up with you. I've been looking forward to discussing this with you. Can I just pick up on that last point you made in that quote there, Bill, that ultimately the GLP-1 overhang has largely played out? What convinces you, Bill, of that?
Good morning, and thanks for having me. Yeah, there are two things there. One, today there's a $68 billion indulgent snack market. I mean, you think about how many snacks you've had over the past week and how many of them were indulgent or sweet versus better for you or healthy. And I think you'll find that it's a very, very strong market and people still like their sweets. And Krispy Kreme is only about $1.5 billion of that. So less than 1% of the total market. So our belief is even if the pie does shrink over the next few years because of Ozempic or Wegovy or GLP-1s, there's still a lot of room for this company to grow. The second part, Krispy Kreme will say they're in the business of dozens. They're for parties, they're for office gatherings, they're for stuff like that. And while certainly GLP is going to have some impact, as we put in the note, you don't want to be that guy who you're on Ozempic and you bring the vegetable plate to your kid's 9-year-old birthday party. Yeah, I think there's still going to be a good, steady demand out there for these donuts, especially because they taste so good.
Hey, Bill, you don't know me. That's all they'll be eating, carrots and broccoli. But that's another story for another day. Bill, you said this relationship with McDonald's is an important one. When we speak to some of these companies, they talk about diversifying, healthier snacks. McDonald's isn't what I typically think of as healthy, and this isn't what I would indicate as diversification. Bill, why is this partnership so good for this company?
Sure, thanks. Two things. It's good for both companies. For McDonald's, they want to have something different on their menu. It's a treat. Again, it's an indulgence. Much like you would have an ice cream cone at McDonald's or something like that, but throughout the day. And so it does diversify what you can offer. And again, we like to treat ourselves with something. For Krispy Kreme, it brings them to the kind of the major leagues. I think a lot of retailers, a lot of even consumers think of it as a sleepy Southern treat that, hey, if I'm in Atlanta or if I'm in Charlotte, I'm going to stop in and try a Krispy Kreme, even though there are locations throughout the country. And LA is one of their top 3 markets. And so this makes it available to everyone. It's kind of like you think of Chick-fil-A. People don't worry about Ozempic. When they think of Chick-fil-A, they just think, hey, that's great stuff. I want to go and find one. And I think the same thing, bring them to the big stage, you'll see them more available, not only at McDonald's, but I think national mass retailers like a Walmart, like a Target, regional grocery stores that are not in the Southeast, like H-E-B or Myers. This opens a lot of doors for availability of Krispy Kreme. And again, these are not your old 7-day-old donuts. This is delivered fresh daily, tasting like a Krispy Kreme, like you just bought it from the store.
Oh, this is killing me. John, I have to tell you that my first assignment when I was in Fargo, North Dakota, I was 22 years old, and there was a Krispy Kreme donut store that opened up, and people camped out for the privilege of being the first in the door to have the fresh Krispy Kreme donuts.
Won't surprise the audience that you wanted to do an investigative piece. And you didn't just want to go down there and interview people.
Yeah, I wanted to know what was in it, whether it was truly fresh.
What was behind the lease for the store?
Exactly. Whether the finances were solid. Bill, I am curious about, whether this is sort of a broader thing or whether you just love Krispy Kreme. I mean, basically, do you think that on a broader scale, the disruption from GLP-1 drugs has basically been borne out in the market? Or is this just basically you love Krispy Kreme?
No. I mean, I think I cover several snack food companies and packaged food companies, and I think you can look to last August till today, and there's been just an overhang on the whole category. Now it feels like that's baked in, for lack of better puns, and I feel like it doesn't mean it isn't going to have an impact, but now there's a decent amount of the population that's on GLP-1s. They're acting the way they're acting. They're buying less, and you're seeing that in kind of packaged food volumes declining. And so I think you see that reflected in packaged food stocks. With Krispy Kreme, again, the stock is down, even despite the McDonald's relationship, down 20% year to date, and 60% from the high that it had right after the McDonald's announcement. And so that's where I feel like, okay, seems overdone. You're kind of throwing the baby out with the bathwater.
This feels like an ongoing conversation, Bill. Let's do this again soon. Bill Chappell there at Truist on the latest upgrade. Thank you, sir. That stock is positive in the pre-market by 0.7%. Alicia Levine of BNY Mellon is back with us. Alicia, we talked about AI and NVIDIA. GLP-1s has been another massive feature of the whole trade. I feel like healthcare just got reduced to GLP-1s. Was that the wrong move?
Well, it's not the wrong move. It was the most obvious move. But I think what you're going to see with AI in drug discovery is going to be a boom in very effective drugs for diseases that we are very unhappy with, that have been very hard to treat. So I think that is the sort of the second derivative trade here in AI, which is drug discovery and drug targeting and molecule targeting. So that's actually really exciting. I mean, it's part of our excitement over AI because it's going to filter through the entire economy, and every business is going to have to incorporate it. And I think healthcare is the prime area that you're going to see great outcomes from this.
I agree, and I'm glad you said that because, frankly, I'd rather see AI create a new cancer drug than an amazing Bitmoji. But that's just me. I am curious, though, just to go on the GLP-1 drugs, do you think that it's been overstated, that this will be revolutionary, we'll all be skinny, we'll all not want to eat foods except for carrots and broccoli, which I actually happen to like?
So we have a terrific healthcare analyst named Matt Keeler who analyzed the food market, the drug market, all of it. He thinks it's overall a $500 billion market, $500 billion. Okay, and that's not with massive assumptions because it works on not just obesity, but it turns out you get better outcomes in cancer, you get better outcomes in kidney disease, and you get better outcomes in heart disease because obesity is a comorbidity for all these diseases that kill us. And so it actually could be extraordinary here. Okay, so it's a huge market. And to the extent that you're seeing data and other disease indications, it's just going to keep on going. I mean, yes, that kind of margin that we see with Novo or Lilly is every other company's opportunity to come into the market. But overall, the excitement, I think, is real, particularly in these other disease areas. I mean, think about it. If someone did a trial on alcoholism, right, because it works on impulsivity, what would that do to the market?
A $500 billion market, is that including the impact on other kinds of food items that we consume here in the United States?
He's just talking about the drugs itself. So to the snack issue, he sees just a 1% calorie reduction, which is not enough to affect any of these snack companies or McDonald's or anything.
Wow.
Yeah.
Okay, Alicia, thank you. Alicia Levine of BNY. When was the last time you had a donut? Ages, right? I'm pretty sure Katie Lyons said on this program that she'd never had one before.
Yeah, that's insane.
Do you remember that?
Yeah, she also hasn't had like dark chocolate or
something like that. Never eaten chocolate.
I mean, I've had donuts before. I used to get them for my kids' birthday parties.
Oh, right.
I would get them
and bring them to school. Buy them by the dozen.
It's true. I'd bring them to the school, and then I'd be like,
Oh, you were that mum?
I was that mum.
Like super popular.
Oh, totally.
Everyone loves that.
Everyone gets a donut.
Yeah.
Get some seconds. Here you go.
People love coming to my house as kids because we had Italian food. Oh. It's freshly made, everyone loved coming to my house for dinner.
That sounds amazing.
Oh, it was amazing.
Yeah.
I miss it today. I'd still live with my mum if she was in America. Any day.
She can come over anytime.
Cook for us anytime. Private chef, I would love that. Mum, I'm sure you're watching.
Yeah, exactly. Come back.
Coming up next, TD's Mark McCormick alongside Santander's Stephen Stanley, counting you down to CPI tomorrow morning. At 8:30 tomorrow, it will be the only thing we're talking about. For MC, might already have that economic data because they've got to plug it into their projections for the next couple of years. So we'll see what they've got to say at 2 p.m. when we get the statement and their projections. 30 minutes after that, a news conference with Chairman Powell. Equity futures on the S&P negative by about 0.25%. The opening bell, 60 minutes away. 60 minutes away from the opening bell. Equity futures negative by 1/3% on the S&P 500. On the Nasdaq, we're down about 1/4. On the Russell, we're down 0.75%. Turn the page, switch up the board and check out the bond market. The scores look like this. A 2-year, 10-year, 30-year with yields lower at the front end. We're down 4 basis points on a 2-year to 4.84. We're down 3 on a 10-year to 4.43.55 on a 30-year. Down a couple of basis points to 4.57. You want a snapshot of Europe right now? It's a lot of red. Looks like this. French equity market down 1.2%. French bonds down, yields up 6 basis points. The euro just a little bit weaker here, Lisa, breaking down. Remember last week after the ECB, we saw 109. We're back down to the low 107s right now.
And a lot of it stems from the snap election. Iain Stealey of JP Morgan Asset Management brought us something that I thought was really important, which is France was just downgraded recently. And there is this problem about a debt load that's going to get a whole lot worse if you have a government that wants to borrow and not necessarily raise money. That is the specter being raised there. I know it's an idiosyncratic story on one hand, but is it? And I think that's the increasing story. There is a market response to sort of spending profligacy. And we're seeing that around the world, not immune to it here in the United States, certainly. And it's the reason why people are wondering about the political risk, really, that we're not pricing fully.
Do you think this sort of like Liz is going to make a visit to the French bond market? Is that what you're trying to suggest?
Liz, if you're out there, you've been trying to reprise your reputation through a lot of interviews. I think that it could be an interesting warning meeting if she met with Emmanuel Macron, although I'm not sure he's the right person to be with. The
ghost of Liz Truss's government sort of making its way around global bond markets.
That was an amazing moment when an actual fiscal change or a governmental policy shift could have that massive of a significance on the currency market, on the debt markets, to spur a central bank response. Was that sort of the whiff of something that was not the first?
Could we see more of it? And I know you're not suggesting sort of stress and that pension fund related stuff that took place in the UK. I know you're not suggesting that. Just the bond market pushing back against a policy that a government might suggest.
Especially at a time of such uncertainty where we've seen such volatility in the bond market. We were talking to Alicia Levine just now, and she said that she actually sees more volatility in the bond market than the stock market because of a lack of certainty on where policy is headed, a lack of certainty on inflation, and a lack of certainty in fiscal policies and how they will be received by the bond market.
A lack of certainty around financial stability as well. You'll notice a theme in our story lineup. Under surveillance this morning, PIMCO saying more regional bank failures are on the way. John Murray, the head of the firm's global CRE unit, saying, quote, the real wave of distress is just starting and that lenders still have a very high concentration of troubled commercial real estate loans on their books. Murray also pointing to US debt funds where more than $200 billion of loans are set to mature through 2025, which he says will struggle to refinance with higher rates. These are the so-called very slow and very long variable lags that you've been talking about.
And it really speaks to Mark Zandi's analogy of the system as this sort of engine that's kind of shaking violently and has pieces of duct tape around it in the form of a lot of Fed policies. Look, there is a real risk here. And it's clear, according to a slew of data points that we've gotten over the past few weeks, showing that there really is some concern, and we haven't had the full repricing yet. We even heard from Bob Diamond, who's constructive on regional banks. There needs to be more merging. There needs to be more consolidation one way or another, or else they'll just be failures. It seems like that is a risk. Question is, we can know it's going to happen and not understand the consequence in markets. Do people have the same kind of trigger response to it the way they did with Silicon Valley Bank?
We're seeing it happening, particularly in CRE. Here's an example of it. We've got a building here in New York City owned by a related company's affiliate, set to be sold at a really steep discount. Empire Capital and Namdar Realty agreed to purchase the property at 321 West 44th Street for less than $50 million. According to people familiar with the matter, that's a roughly 67% discount from what was originally paid in 2018. And there is a loan outstanding for far more than that $50 million.
Yeah, about $100 million. So basically, this is an underwater loan at a time when it's not the first, it's not the only one, but we haven't seen that many forced sales. And arguably, as people try to unload some of this, you'll get actual price discovery, and that can be brutal. This was P. Diddy's studio. He was on the second floor of this building. It is on 44th Street in New York City. There are a host of different establishments around there of varying degrees. It just raises this question of how far are we? What inning are we in the commercial real estate destruction, is it really specific to office space and specific properties in specific cities, or is it more widespread with a greater degree of potential exposure?
Starting to come to the surface, that's for sure. Investors looking ahead to tomorrow's doubleheader. We'll have CPI at 8:30 Eastern time, followed by a Fed rate decision at 2 p.m. Investors expecting the Fed to hold rates steady, but we'll be looking for clues from Chair Powell's news conference about when they might start cutting. Joining us now to discuss is TD's Mark McCormick alongside Santander's Stephen Stanley. Gents, great to catch up with you. Stephen, I've got to start with you. We caught up with you a few months ago. I believe you were sat right here to the right of me, not to the left of me. And I was speaking to this individual about when we were going to get that first interest rate cut. And you said something like November. And Lisa and I sort of looked at each other like, this guy, a little bit nuts, a bit crazy. Start at 24. Everyone's looking for March. And you're like, November. November. It's still November, isn't it?
That's still my call. Yeah. Yeah, I think the inflation data are not cooperating, so it's still going to be a while.
How do you think they'll view the labour market data from Friday?
Yeah, I mean, I think Chairman Powell kind of broke the link a little bit between the labor market and the economy and inflation earlier this year when they suggested that maybe we can have the economy continue to grow and still get inflation down. I think that was a bit of an ill-fated shift on his part. But I think the labor market only comes into play, it feels like, if things start to weaken dramatically, and obviously may suggest that that's not happening. So it's back to inflation.
Matt McCormick, I want to turn to you. How important is tomorrow morning's payroll CPI print?
I think it's important, but I think, as you mentioned, the key thing here is like progress on inflation. I think that's part of the thing is it's a stumbling block. We're not seeing the progress that we need. You're also going to see the Fed likely revise up their core PCE numbers in terms of the target number they're looking at. So when you think about whether or not inflation is moving in the right direction, it is. Is it moving fast enough for the markets to kind of get on board with the certainty of how many times they can cut this year and reduce the volatility in the bond market? I don't think we're going to see that tomorrow. So I do think the key here is there's an intersection of volatility that's not priced in the markets, the geopolitics, which continues to push on the fiscal side, and the fact that the markets aren't really prepared for any of this.
So do you think, Mark, that the Fed's going to respond to this by doing absolutely nothing, trying to keep things as stable as possible and having an otherwise, just in terms of the balance, a bit more of the dovish side of things than hawk?
Yeah, I think they're going to try to sound neutral. They can't really project anything into September or November or December at the moment. They still need to see 4 inflation reports till we get to the September meeting. So I think right now the forward guidance, and I think markets understand this, there's not much significance that comes from forward guidance because we're all data dependent. So as we kind of watch the data come in, if it's a soft month over month, which is maybe a 0.26, or if it's a hot month over month, which is maybe 0.28, we're talking about decimal points, which, the Fed can't really provide the guidance for the markets to feel very clear about where we're going on this. And I think the one thing that, most people who are covering the market now feels much clearer about is we're just going to see more volatility. And I think that's the key thing that we need for markets is really you should be trading and thinking about the surprises. Everything needs to go right to get to this clear path, but you only need 1 or 2 things to go wrong. And that's where the asymmetries lie for markets, especially on the FX side.
All right. Well, we'll get to the FX side in a second. But, Stephen, from your vantage point, this extreme volatility, is there a cost to that when it comes to both economics, but also just market risk when we talk about how rapidly some of these yields are swinging, even if they end the day at the same place?
Well, I think it makes it very difficult as an investor. And the Fed certainly doesn't like to cause volatility, so they're going to try to do what they can to give an accurate picture of where they're headed. But the problem is that they're data dependent. And so if the data are volatile, back and forth, high and low, then the markets are going to be volatile and the expectations around the Fed are also going to be volatile.
Do you think they still believe that financial conditions are tight?
I think they believe that the level of the funds rate is very tight. Obviously,
What do you think that's based on? Because we heard from Bill Dudley, former New York Fed president, wrote a great piece on Bloomberg Opinion and said maybe it's high indefinitely, not high for longer.
Yeah, I think that the problem for them is that there are tailwinds that are working against what they're doing with the rate level. One is their own balance sheet strategy, where the balance sheet is still too big, and that's a lot of excess liquidity sloshing around in the system, making financial conditions easier. And the other one is fiscal policy, which is continuing to stimulate the economy.
The stress that we are seeing, pockets of it, We're seeing it at small banks, regional lenders, saw that last year. Got PIMCO this morning warning of more to come. We're seeing certain buildings have some difficulty and get priced at really, really steep discounts, particularly here in Midtown Manhattan. Another example of that. Where do you think that is on the radar for these officials?
Definitely watching it. I mean, I think to some degree, the Fed probably looks at the CRE situation and says, look, this is something we can't really address directly because this is a secular change in the demand for commercial real estate after COVID, right? So there's only so much they can do. They can help to smooth the transition, but this is a change in the valuation of this sector that needs to happen. But I think what they're watching more broadly is, are we seeing the effects of high interest rates? And it does feel like we're starting to see that more. You're hearing it more in the housing sector. The ISM non-manufacturing report last week, there were several mentions by respondents in different industries who were saying high interest rates are really a negative for my business right now. So, I mean, I think from that perspective, they're probably justified in feeling that the policy rate itself is high. But as you say, financial conditions generally are not particularly restrictive.
Mark, to build on that, I remember a couple of months ago, people were looking at property markets around the world to determine which currency to go with. That was actually one of the big risks and potentially indicators of a central bank that would essentially be forced to cut in order to preserve the sanctity of the economy in that region. Do you think that that's still applicable?
Yeah, that's something we track very closely. We kind of look at the effective mortgage rates and how it's correlated with interest rates and kind of which currencies are the most vulnerable to that. You could play the home base here, but it's very clear this is on the Bank of Canada's radar screen. And it's very clear this is something that was on most European currencies' radar screen. I always find the primary case study was Sweden, which was if you looked at the mortgage rates, the bulk of the mortgages were under 1 year and they were floating. So Sweden already took the pain medicine and they've already had a massive move in the currency market. Things are starting to stabilize a little bit, but that is something that's on, I think, the radar screen, which are the next tiers of countries that are very vulnerable to a housing disruption. And again, this is something that's very insulated and something that's resilient for the U.S., at least relative to other currencies and how you would look at the housing market as an impact. So I'd say the one that's on everyone's radar screen that we talk to happens to be Canada. Largely, again, because they're mostly under the 4 to 5 year fixed, and those fixed mortgages are adjusting from the COVID period now. And you're basically seeing mortgages go from 1.5 to 2, all the way up to maybe 5-6%. So that is something that is going to feed into consumer spending, consumer slowdown. And this is part of the G10 central bank divergence story, which is, the Fed might not just have to go as quickly or might not be able to go at all, where all these other central banks do have to go, and they have to go now.
Stephen, housing is one thing. Commercial real estate, though, is another. And you are seeing, as John mentioned, $200 billion of maturities coming up within the next 24 to 18 months. And there's a question of whether we're accurately pricing the risk that this could cause the Fed to respond in a more material way. Should it be, I don't want to say contagious, that might be too strong, but have sort of trickle-out effects. Do you buy into any of this? Are you watching this to really understand that risk?
Well, I think one thing to keep in mind is that, I mentioned the balance sheet before, liquidity is still plentiful, right? So this isn't likely to lead to a broader credit crunch. I think the other issue is, unlike the housing situation 15 years ago, there's not a ton of leverage spread through the system that hinges on commercial real estate. So I think the risks are very different than they were in the lead up to the financial crisis. Having said that, I have to say, banks are sitting with a lot of loans on their books that are in some jeopardy. So I think there will be further adjustment going forward. It's just a matter of how broad that pain gets and what the overall environment. Is it resilient enough to manage through that?
We're going to continue this conversation with Mark McCormick at TD. I know you've got to run, so I just wanted to get some details from you. November's when they're going to move. First cut, that's your call. Can we just go to the dot plot just quickly tomorrow? What's that look like, 2 or 1?
I think it's median is probably 2. There'll probably be a minority of people with 0 or 1, though.
What do you think the forecasts directionally are going to look like? Are we revising growth up and inflation up, unemployment higher? What's that look like?
Not much of a change in growth and unemployment, but probably we're going to need to go up on inflation just by what's already happened.
Just a nudge higher on CPI. The difference between the Federal Reserve and the ECB, though, is that they do that and they're not cutting interest rates on the same day.
Well, they weren't pre-committed. So
can you imagine? Can I just finish on that? Can you imagine if the Fed did what the ECB did last week? What do you think that would look like in markets?
Well, so the Fed historically has tended to have a very high bar for their first move. And the ECB, as you said, kind of locked in that first move early. The Fed has never really behaved that way. So it's hard to say, but yeah, that would have been interesting.
I forgot who wrote the article, but it was someone here at Bloomberg that referenced a reverse Trichet. So Trichet, for those of you that maybe aren't familiar, former ECB president, did a couple of hikes at precisely the wrong time. I think one was in 08, another series of them around 2011, around the Eurozone debt crisis. A reverse Trichet big, ultimately, you've cut too soon, that the cut's the mistake this time and not the hike.
Well, we'll see. I mean, is that really the reason why the euro is weakening so much? Probably some other issues. But it's a good question, and it's something that people are going to be asking.
Yeah, something we'll keep asking. Stephen, it's good to see you. Thank you. Santander, Stephen Stanley there, breaking it down on the Federal Reserve tomorrow. Mark McCormick's going to be sticking with us. Let's get you an update on stories elsewhere. We can do that this morning with Danny Berger. Hey, Danny.
Hey, John. Shares of Apple down just 0.1% this morning. At its Worldwide Developers Conference, the iPhone maker announced a new partnership with OpenAI. It also unveiled features called Apple Intelligence that will roll out later this year. And more advanced tools, those won't come until next year. Donald Trump will meet with Senate Republicans on Thursday. It's an effort to plot out his priorities if he wins a second term in office. Senate Republicans hope to win a majority in November, which would give them the power to push Trump's legislative priorities and cabinet picks. Trump has a busy schedule. He'll also be participating in a meeting with CEOs hosted by the Business Roundtable. Singapore Airlines has offered payment of $25,000 to passengers who sustained serious injuries during a flight that hit extreme turbulence last month. The payments would be to address their immediate needs, the carrier said in a Facebook post on Tuesday. They're also offering a $10,000 payout to passengers who sustained minor injuries. One person died and several dozen of the 229 passengers and crew on board were severely hurt on the flight that departed from London to Singapore. It was forced to make an emergency landing in Bangkok. And that's your Bloomberg Brief. John.
Danny, thanks for this morning. Appreciate the update. Up next on the programme, we'll set you up for the day and the week ahead. Looking ahead to tomorrow morning for CPI, tomorrow afternoon for the Federal Reserve. The opening bell, 42 minutes away. All-time highs at a close to kick off the trading week. Coming into Tuesday, equity futures down just a little bit today. We're off by 0.25% on the S&P. Got a bond market rally, though, for you. Yields are lower by 3 basis points. A 10-year 4.4355 after yields climbed on a 10-year for 3 consecutive days. Pulling back on a 2-year, too. We're down by 4 basis points at 4.8361. Here's the trading diary for the week ahead. This is what it looks like. The Fed kicking off its 2-day meeting today. Wednesday, we'll get US CPI data, the Fed rate decision, Chairman Powell news conference. Thursday, PPI, and another round of jobless claims. Friday, UMich consumer sentiment plus a BOJ rate decision. Mark McCormick of TD is back with us for some final thoughts. Mark, data, central bank decisions, all super important. I want a word on politics, if we can. Mark, all of a sudden, politics, EM, India, DM, France, DM again, the United States later this year, the UK somewhere in between. How important is that going to be as a dimension of foreign exchange for you?
I think it's absolutely critical. It's one of the things we've been talking about for at least a couple months now, and it's one of the reasons why we massively upgraded our dollar view for the second half of the year. I think a big piece of it is the market's really focused on Goldilocks. And as we talked about in the last block, there's a lot of things that need to go right, and there's only a couple things that need to go wrong. And I think a big piece is if you look at geopolitical uncertainty and geopolitical risk as an index, and you overlay that to FX volatility is extremely cheap. And the thing that we're seeing is that I think this works really well with the intersection of inflation, monetary policy, fiscal policy, because what we're seeing from any government, whether it's a left-leaning government or a right-leaning government, is they want to spend money. And we're in an environment where inflation is high. And what's very, very important for the FX market is that there's inflation divergence. And when you have inflation divergence and you have central bank divergence, that is a key ingredient that allows the currency markets to absorb what's happening in the market and trade off those types of themes. So I think all of this is kind of working together. And what the last week showed us is there's just very, very strong cracks that are occurring in Goldilocks. We just can't have this little macro vol with this much disruption and this much potential change. And I would say one final thing on the FX side is that the most important strategy that people are normally focused on is to carry trade. And a lot of the currencies you mentioned, especially Mexico and India, have been the darlings of either EM equities or EM-based carry strategies. And now what we're seeing is that the one thing that disrupts carry is volatility.
There's a lot to unpack there. You said you are massively overweight the dollar heading into the second half of the year. In the second half of the year, with the election in mind, you also see an opportunity being long FX volatility. Just park the volatility for a second. What's the thesis behind massively overweighting the dollar?
A lot of it is the intersection. So it's like the dollar is the vol trade for FX, in my opinion. So if you kind of run any kind of correlations of risk sensitivity to currencies, there's really no more safe havens. The yen is not acting like a safe haven historically like it did. The interesting part is that the Mexican peso and the Indian rupee were currencies that acted like safe havens. So what we're seeing is the correlations are changing and the market's evolving. So the dollar is still kind of the only place to go. I think a big piece of it, again, is that people have been focusing on the weakness in U.S. data surprises. But what we see is data surprises correlates very closely with our positioning model. So I don't think data surprises is telling us a lot about economic momentum because there's other indicators you can track that our models are still quite long the dollar. So I think a big piece of it here is that the macro fundamentals, in spite of the dollar weakness over the last 6 weeks, have actually improved on the indicators that we track. And the adjustment that we saw in the weak dollar story has really been just more about technicals, positioning and short-term valuations, which is what we capture in our model. So I think the second half of the story of the dollar is rooted in two things. The macro story in the U.S. is still better. There's still not certainty on whether or not the Fed can cut. And the U.S. election itself can be very disruptive for the seemingly important trade that everyone's focused on the last 6 weeks, which is U.S. data is converging with rest of the world data. And if you start talking about tariffs and fiscal stimulus in the U.S., and potential for volatility there, that's something that can disrupt the non-U.S. growth story.
So how big could this rally be and how disruptive could that be to markets that have been looking for some weakness on the dollar?
Yeah, so the way we look at it is, again, idiosyncratically, we believe the BOJ is going to hike more than expected. We do look for them to actually start to talk about moving this week. So we do expect a hike in July. So the yen can actually kind of nuzzle itself away from the dollar a little bit and rally against other currencies. But we are looking for euro to break 105 and actually by the first quarter of next year get down to 102. So that's a forecast we've had now for about 2 months. So yeah, we are looking for pretty significant dollar strength based on the potential evolution of that type of feedback loop where it's inflation is a little bit too sticky. It creates conditions where risk starts to sell off. Most of the currencies, again, outside the dollar are heavily correlated with risk. And that creates a little bit of a negative feedback loop that feeds into a stronger dollar across the board.
Mark, as you were speaking and you were talking about how regimes were changing in foreign exchange, I was thinking of a few guests that have been on this program over the last year who were talking up the peso as like a haven within EM. And then dollar MEX just had this 8% move last week, just big breakout. And the weakness continues again this morning. If you believe we have that kind of dollar strength that takes the euro back down towards parity or close to it, Mark, where does it leave EM currencies like the peso?
I think the peso is unique. I think a big piece of the sell-off is one, there was just a massive surprise from the events. And obviously, we've seen some reform agenda come from AMLO that's not exactly exciting for institutional investors. If you look at